Welcome into Yahoo Finance Live. I'm Shauna Smith alongside Miles Udlin. We are just about 2 minutes here until we get the numbers for the December jobs report. In terms of what we are expecting, 175,000 jobs to be added to the U.S. economy in the month of December. Unemployment rate to tick up 0.1% to 3.8%. A number of items within this report, Miles, that investors are going to be paying very close attention to. Average hourly earnings is another one, obviously, when we talk about the Fed's fight here to tame inflation. In terms of those expectations, we're looking for growth here, month-over-month basis, 0.3%. That would be an improvement, if you want to look at it that way, from the Fed's point of view, from a rise of 0.4% the previous month. Annual wages could be below 4% for the first time in about 2.5 years.
Yeah, and I think, it's an interesting jobs report in the sense that I think for the Fed, there's not a ton of drama. I think we have a pretty good feel for what the Fed's going to say in about 3 weeks. Markets are convinced they have a really good feel for what the Fed's going to say pretty much for the rest of the year, depending on how you want to read the dot plot, read Powell's statements and others. A number that I'm looking at ahead of this is just a good old-fashioned unemployment rate, 3.8%. And just kind of going back in time, it's been basically the better part of 6 years, X out the pandemic, and we saw, kind of the 18-month recovery there in the labor market. But it was 2018, we were talking about the unemployment rate coming under 4%. And it really is, the longer that this goes on, the more amazing it is how long we've seen unemployment at this level in that, 3.5 to 3.9% range. And discussions this year from a lot of folks on this program about unemployment getting towards 4.5% this year, that potentially moving the Fed to cut. Shauna, we're not that old, but we're old enough to remember when 5% was enough for the Fed to begin raising rates on the other side of it. Remember 2012, I think it was, the Evans rule, 6.5% unemployment rate would be the impetus for a rate hike. And so we've certainly seen that conversation change quite a bit over the last several years. I know, Shauna, you have the numbers here for us.
Yeah, Miles, are coming in right now. A very strong report here, much stronger than what the street was expecting. 216,000 jobs added to the U.S. economy in the month of December. That was beating the street's expectations of 175,000. Taking a look at the unemployment rate, that actually coming in line with what we saw last month, so 3.7% below what the street had been expecting at 3.8%. Average hourly numbers here month over month, we saw a growth of 0.4%, which was more than what we had initially expected. That year over year change of just about 4.1%. You can see the reaction in the futures market, at least initially off of these headline numbers. We're looking at losses still across the board. Dow futures pointing to an open of off just about 0.5% here, Miles.
Yeah, and you look at the labor market here. I know we're going to get into it quite a bit, but an interesting report for the participation rate, and thinking about, we saw a slight downtick there, 62.5% from 62.8% in November. So really a lack of participation, I think, is probably going to be the math here driving down the unemployment rate. So if there's a negative way to interpret a 3.7% unemployment rate, perhaps, and we saw a slight uptick in unemployment earlier this year on an increase in participation, perhaps that is the slight rub within this report. But I think ultimately a story of slowing, but slowing less than expected overall jobs growth. And really the simplest way I think that policymakers look at the labor market is just, are more people getting jobs than are losing jobs? And we continue to see that trend remain the case. I know we see a little bit of move in markets here. The NASDAQ futures now down about 0.6%. I believe we have Jared Blickery standing by for a little bit of a look at what's happening across markets here in the very early going, Jared, following the release of these jobs numbers.
Miles, I think it's instructive that we were down before the market even had the attempt to, the ability to process this report. NASDAQ now down about 0.6%. It's the worst off of the majors and the Russell 2000. And you can see, in fact, let's take a 5-day look. This is going to span into the end of last year, but you can see that ever since this year began, it's been a slow and steady decline here. And you take a look at what's happening in the interest rate structure. 10-year T-note yield futures are taking a dive right now. That means the yield is going up, and yields climbing this year has been a story. The dollar climbing this year has been a story, and those have both been headwinds against the risk assets. Let's take a look now at the euro versus U.S. dollar. That's a proxy for the dollar. You can see the euro's weakening a little bit. That means the U.S. dollar is getting stronger. So more evidence that maybe, just maybe, the Fed pivoting right here is just a little bit premature to call. This is just one report. So this is not by any means all the evidence that the Fed would need, but given that all the big metrics here, all the headline numbers are hot, I really think that's instructive. Want to show one more market here. Just remember, gold futures have been on the move. Gold sinks on this report. Is that handicapping the Fed right there? Have to see. One more thing, sorry. Bitcoin. Always got to check out Bitcoin. I didn't see it moving a few minutes ago. A lot of times this will be the biggest mover of the day, but we haven't seen it getting started yet off of this report.
All right, Jared, thanks so much. We'll check in with you in just a little bit. We want to get reaction to this better than expected jobs report here. Again, that headline number coming in 216,000. Wage gains were also stronger than expected on a month-over-month basis. We saw a gain of 0.4%. We want to bring in Neela Richardson, ADP chief economist. We also have Stephanie Roth joining us in studio, Wolfe Research chief economist. Stephanie, let me start with you just in terms of this better than expected jobs report that we're getting here this morning. What do you think this does for what Jared was just talking about in terms of the Fed's timeline here, potentially delaying that first rate cut?
So our base case has been that the Fed's going to cut in Q2. I think March is a bit early. So I think that still puts that in play. The report was kind of a bit interesting. So when you look at the establishment survey, we got, a better than expected headline print. We got some downward revisions to the prior month, so let's keep that in mind. Some of that was kind of offset to some extent. Wages were certainly strong, so that was certainly a negative when you look at from the Fed's perspective. But then when you shift to the household survey, that looked quite a bit weaker. So we got a decrease in participation, but the unemployment rate was pretty steady because you had a pretty sharp drop in household employment, which is kind of a reversal of what you got the prior month. So the household survey was kind of a bit messy when you look at it. So overall, I would say probably doesn't change the timing too much, at least from what we were expecting. Perhaps the March expectation is perhaps a bit early.
Yeah, and Neil, I want to bring you in on this one. And just thinking about the story we've had for the U.S. labor market over the last several months of this resilient but continually slowing growth, I know that the headline job gains here are going to get a lot of the attention because that's, the easiest number to digest. But does this really change? Does this report change the story that you think is the overriding one right now for the U.S. labor market?
It does. I do think it does change that. We look at the data at ADP very, very closely. And we put out a report just yesterday showing 164,000 private sector jobs. I had to check the number in this BLS report twice, maybe 3 times, because it's the same number for private sector jobs. And what we're seeing is a bump up in the private sector. So in October, November, they were running close to 100,000 with the withdrawing strength of leisure and hospitality, which was the stalwart of 2023. Now we see a resurgence in December in the private sector. Again, a healthy dose of leisure and hospitality after it had been declining for several months prior, and then continued strength in healthcare, and notably construction, which is an interest rate sensitive sector. So I think what we're seeing is a bit of a bump up at the end of the year that maybe the Fed will take notice of.
And I guess, Neela, in thinking about that change in the labor market, is this kind of maybe a way to interpret the corporate sector's confidence that we are not tipping into recession? Really the opposite, kind of what we had the conversation this time last year. And though it is on the margins, it seems to me, as you're outlining it there, that most managers who were looking at the economy going one way now are comfortable betting that it's actually not going to happen as we get into this year.
The business sector can't rest its operations on whether or not we're going on recession. That's a story for Wall Street. That's a story for analysts. The business sector has to keep operating regardless of the economic environment. And I think they're very close to what's going on with companies. And what we're seeing with companies is consistent hiring, especially with small businesses. ADP has a really good read on small businesses. They continue to hire with strength. And so overall, the picture, what they're seeing from consumers, still strong, still spending, with companies still hiring, is a pretty solid economy. Now, those interest rates are going to have an effect. We're knowing that consumers are shifting more into credit card debt, and interest rates are at 2-decade highs. There's some a frozen pond of housing market indicators because of lack of inventory. So the economy is solid, but there are some gaps that need to be filled. But for a report at the end of 2023, I think we're in pretty solid footing.
Stephanie, I want to go back to you on wages and what we're seeing there, because we've been talking about this rebalancing that's happening right now within the labor market. But the fact that we did see an increase in wages on that annual basis, the month-over-month number coming in hotter than expected. What is that going to do just in terms of how much this could potentially complicate that last mile of the Fed's ability here to really bring down inflation back to 2%?
You know, I'm not that worried about the print that we got. We're going to get the ECI at the end of this month. That's going to be the gold standard when we're thinking about wages. So the average hourly earnings number also is, we are calling for a 0.4 in part because the survey week fell later in the month, which tends to push up the print. So the ECI doesn't deal with stuff like that. And then if you look at the couple months prior to the last two, average hourly earnings was kind of depressed. So when you look at the broad picture, you are still seeing a decelerating wage dynamic. So this print doesn't really call that into question. I think we're going to be, all eyes are looking for this ECI print that we're going to get in just a couple weeks, and that's going to really be what's most important. And my guess is we'll continue to see this deceleration in the wage backdrop.
And I guess we've talked a little bit about revisions so far following today's report, but just in your guys' work, as you think big picture about the U.S. labor market, where revisions fit into that conversation, I think we're going to get the benchmark revisions maybe next month or in March. How do you think about that in telling the full story of the U.S. labor market? Because I think for a lot of investors, it's kind of a hot money day, right? You come in, here's the headline, no one remembers oftentimes how it was revised. So how do you as an economist think about that?
I mean, the revisions have been so difficult for the past couple of years, especially since in this post-COVID environment, it's been really difficult to seasonally adjust properly. Typical patterns are quite a bit different than what they have been over the prior couple of years. So it's difficult for investors, and that's one reason that drives a lot of the volatility from print to print. I like to just look at longer-term trends, 3 and 6 month trends, to try to look through a lot of this noise, and look at a lot of different indicators to try to confirm and look at a broad picture of the economy. And what we're seeing, broadly speaking, is the economy is still pretty firm. We're not headed to recession in any time soon. And wages have inflation has come down. We're now looking at inflation just sitting above 2%, which is not that far from where the Fed wants to be. And that's why Powell was able to turn a little bit more dovishly recently. And those trends are still in place.
Neil, going off of what Stephanie was just saying, just some of the trends that have been in place or are in place right now, how do you see the labor market shaking out? Not taking a longer term view, but 6 months from now, 9 months from now, what do you think those numbers will look like in terms of some of the slowing that may be pushed out a little bit just in terms of what those expectations were initially going into this report?
Yeah, I think we're going to continue to see some solid hiring, but there are going to be weak spots. Manufacturing in particular is weak, quite weak. We saw it shed jobs last month, and I think the survey indicators still point to continued shedding of jobs into 2024. So we should be worried about the goods sector. But I do agree that pay has gone down in terms of growth. Wages are still seeing a steady decline. We see it in our payroll data based on over 10 million workers at ADP. And I think that is a good story for the Fed, who's concerned about inflation. Wage price spiral concerns that we had earlier in the recovery, they just are not holding water now. And that's good news for those who are really concerned about inflation spiking up again, even in the face of a very strong jobs report for December.
Yeah, and Neil, I wanted to ask you while we have you about those wage data that you guys put out, because you have a really interesting series, which is wage gains for job switchers has actually been declining, or the rate of growth there has been declining faster than overall wage gains. I'm curious how you think about that number specifically, because it's really, again, you talk about on the margins of the labor market, the change in the rate of change. That to me feels like a big mover when it comes to, the wage cost push inflation story.
It is a big mover. And I think what it underscores is the stability of the labor market, which is not something we had before in 2022. The way I think about it is how we started the year in January of 2023. The premium that we measure from switching jobs versus staying at the same job was 7%. So you got a 7% bump in pay by switching jobs typically. That premium has shrunk to just 2.5%. So the return to switching, to trying a new job on for size, has really, really shrunk. And that means that there's just not as many opportunities out there. We're still seeing low unemployment, but the balance between supply and demand has come closer together. That's good news, I think, going into 2024, again, because it points to more moderate pay growth that's more sustainable.
Stephanie, when you look at what Neela was just saying there, just in terms of the fact that maybe we aren't going to see the type of build up here or pay off if you were to switch jobs, given the fact that that's coming back into line with what we saw pre-pandemic. How long do you think that's going to take in terms of this rebalancing to actually work its way out and we see more of what we saw from the trends that we did pre-pandemic?
We're getting a lot closer to the pre-pandemic labor market. We're not quite there. And job switchers versus job stayers, their wages is one of the best ways to look at it. Also, if you look at the quits rate, we're now back down roughly to where we were at the end of last cycle, towards the highs of where we were in the past cycle. So I think we're close to there. We're not all the way. So I think it'll probably be just a couple more months. This rebalancing has happened very swiftly. There was very little expectation for inflation to come back down without a rising unemployment rate, and that has played out because the economy is just kind of getting back to where we were back in 2019.
And I guess, Stephanie, thinking about the later parts of 2024 in the labor market, is there a time where you expect that net job growth would go negative? I know that's been a conversation from some folks. Everyone's kind of been waiting for it, I think, for 18 months now. Haven't really seen it. Is that something that you guys are modeling out, and maybe how you think that would play into the story that you were just discussing around the U.S. economy with this kind of immaculate soft landing here in a way?
We don't have job growth going negative in our base case. Our forecasts are for the softest landing. We now have growth looking at about 2% for this year, which is just about trend. The decline in rates and easing of financial conditions should allow some of the cyclical sectors to actually start to stabilize here. So no, we don't have job growth going negative. It should average in the low 100s this year.
All right, we'll leave it there. Stephanie, Neela, thanks so much for jumping on to talk quickly about the U.S. jobs report we just saw crossing the tape. Again, non-farm payrolls rising by 216,000 in the month of December to cap off a very strong 2023 for the U.S. labor market. We're going to have more on the better than expected jobs report, talk a little bit more about what's happening in markets as well coming up right after this break.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
And actionable information about your investments.
we bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
All right, we're about 40 minutes away from the opening bell here on Wall Street on this Jobs Friday morning. Let's take a quick look at futures here in reaction to that stronger than expected jobs report. We saw 216,000 jobs added to the U.S. economy in the month of December. We see all three indexes pointing towards losses at the open. Once again, the Nasdaq's been down 5 straight days, off about 0.5% in pre-market here. We saw the Nasdaq futures down as much as 0.6% in initial reaction to that. But again, the story for markets here appearing to remain the same as we head into the 4th trading day of 2024, stumbling out of the gate. Joining us now for more on all of the market action we've seen is Ben Laidler, eToro's global market strategist. Ben, thanks for hopping on this morning. So we've all seen the jobs numbers. We've seen the market reaction to that. I just want to take a step back and look at what we've seen over the last couple of weeks, really to start 2024. It was so euphoric, call it early December in markets. It feels like a stumble, but how are you making sense of really just a retracement of kind of that post-Fed hype that we saw from markets, middle of December?
Absolutely. We're seeing a little bit of a sort of data reality check after, frankly, we probably made more money than we thought we were going to make in the fourth quarter of last year. We definitely pulled forward some of those returns. And now, whether it's the sort of hot payrolls number today, whether it's the sort of less dovish Fed minutes we saw early in the week, whether it's inflation numbers going up again in Europe, I don't think any of this is inconsistent with the ECB and the Fed cutting interest rates later in the year. But I think it is inconsistent with just where the market got to of pricing 6 cuts on both sides of the Atlantic starting in March. So I think we're having a little bit of a sort of natural recalibration. I don't think that's too much to worry about. I think this is still a bullish year of accelerating earnings growth and rate cuts, just maybe not quite as bullish as we thought coming into the year.
Yeah, and I want to talk a little bit, Ben, about some of the dynamics we've seen underneath the hood of the market within that kind of late December rally. And it really speaks to what I think you see as the big trade for 24, which is the broadening of the market rally, moving away from some of that heavy concentration, at least in the U.S. markets we saw, particularly around the Magnificent Seven stocks. Apple's gotten a couple of downgrades this week. So can you talk us through a little bit how you're seeing the broadening of the rally, any areas within that you like in particular?
Yeah, so, I'm bullish markets for this year, but I do think it'll be a very different rally to what we saw in 2023. I think it'll be a bit smaller because we pulled forward returns. 26% for the S&P is double the sort of long-term average. Valuations are already pretty high. So I think we need to be realistic about that. Secondly, I think it'll be a bit more back-ended. Again, we pulled forward some returns. I think markets now want to see earnings firm up, which might take a couple of quarters, and they're going to want to see rate cuts actually, us be closer to rate cuts. And then to your point, the other two big differences, I think, is the leadership. I think people are going to start giving up on those sort of defensive growth teddy bear tech stocks in the US and be prepared to look at those assets which are most sensitive to this base case of an economic soft landing and interest rate cuts. And that's basically all these unloved, cheaper sectors, primarily financials, real estate, industrials, and including small caps. And that has real implications for the rest of the world as well, because it means you probably want to own less of the US and more of the rest of the world, which is full of these types of cheaper, more cyclical assets, so particularly Europe and emerging markets.
And Ben, taking a look at the Fed Fund futures here, we just had a new full screen made just about what traders are currently pricing in following this better than expected, at least on the headline numbers here, a jobs report that we got this morning. Now we are seeing traders pricing in a 53% chance that the Fed will cut rates at its March meeting. That's down from 62% yesterday. Ben, when you take that into account and also the movement that we've seen really since the start of the year in the bond market with the 10-year yield now right around 4%, what do you think that move could look like here going forward in terms of some of that upside potential?
Yeah, absolutely. So again, I think we pulled forward some of the returns that we were expecting for 2024 into 2023. I think we got a little bit over our skis. I think we're having a little bit of a recalibration, both in the equity market, but also in the bond market. But your point, I think what's been going on under the hood is this big rotation, which I think is just going to continue. I mean, the Nasdaq's been doing a lot worse this year than the value-heavy Dow Jones, for example. So I think even within this sort of pullback, you're seeing that investors make that rotation. And the other point I would just make, a little bit of money goes a very long way here, because the US is 2/3 of global equities. Tech is 40% of the US. These are absolutely massive assets relative to things like Europe, small caps, real estate, which in the greater scheme of things are pretty tiny. So even a little bit of a recalibration there, I think, could make a really big difference to some of these assets.
Ben, before we let you go, I want to ask a little bit about what we've seen over in crypto world, and certainly a lot of hype around expectations, I should say, that we're going to get the SEC approval of Bitcoin ETFs next week. That maybe is called the fundamental case, but just looking at sentiment for both what we have seen so far from crypto over the last 6 months and what, in your view, at this point in time, crypto markets represent for investor sentiment. I'm curious how you think about that trade in the context of all we've discussed with the equity markets.
So crypto is interesting. So this is the smallest asset class. It's the youngest asset class. It was up 150% last year. So it's been the best performing asset class, admittedly of a terrible time the year before. And I think what's interesting when you look forward is just the long list of catalysts. I mean, we obsess a lot about the potential spot Bitcoin ETF. We'll see whether we get it next week. We've certainly, markets are certainly pretty positive looking at that. But that's really just the beginning of, I think, what is potentially coming in 2024. I mean, we have the Bitcoin halving. We've a lot of sort of institutionalization changes, accounting changes that make it easier for companies to own crypto, bank regulatory changes to make it easier for banks to hold crypto. I wouldn't be surprised at some point if we see, a central bank take the plunge and announce that it holds crypto. So again, in the context of a small, young asset class, I think any one of these catalysts is potentially meaningful.
All right, and moves that we will continue to track very closely here. Ben Laidler, always great to get your insight. Thanks so much for joining us here this morning. All right, we'll keep right here on Yahoo Finance. We got much more of your market action ahead. And again, taking a look at futures here, just about 35 minutes ahead of the opening bell. We're still looking at pressure in the futures trading here, but off the lows that we saw earlier just after this jobs report was released. You're now looking at a 0.2% drop here for the Dow. Keep right here on Yahoo Finance. We'll be right back. Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's the Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
It's 9 a.m. here in New York City. I'm Shauna Smith alongside Miles Udland. This is Yahoo Finance Live, and here's what we're watching this morning. A better than expected jobs report. The U.S. economy adding 216,000 jobs in the month of December, significantly higher than what the street had expected of 175,000.
And a dismal start to the year for stocks continues. The Nasdaq has fallen for 5 straight days. The S&P has also muddled through its worst start to the year since 2016. We'll discuss more on that.
And Tesla facing more issues with its self-driving vehicles. The EV giant recalling more than 1 million electric vehicles in China. The recall coming over concerns about Tesla's assisted steering functions and door latch controls. We're looking at some pressure on the stock here in pre-market trading, off just about 0.5%. Let's kick it off with our top story of the day. The December jobs report coming in hotter than expected on the headline number. The U.S. adding 216,000 jobs during the month of December. Now, it is the first of a slew of data that the Fed is going to be getting before their first meeting of the year. Here to break all of this down and what this report could mean for the Fed's next decision, we want to bring in Yahoo Finance's Jennifer Schomburger. Jen.
Good morning, Shauna. First jobs report since the Fed signaled it has finished raising rates and could soon cut rates sometime this year. But the December jobs report coming in much stronger than expected on all metrics, whether it was that top line non-farm payroll number, wage growth, or the drop in the labor force participation rate, all likely to take the possibility of a rate cut that Wall Street has priced in for March off the table. And indeed, if you look at the CME futures, those bets are being dialed back this morning. The job market based on this morning's data still too hot for the Fed's taste. They would really need to see job growth in the area of 100,000 or less on non-farm payroll numbers per month and wage growth closer to 3% rather than the 4% that we've been getting for them to consider cutting rates. Now, if we do look at the revisions, I want to point out a trend that we've been seeing, which is that the job reports keep coming in very strong initially, but then they are revised lower subsequently. And you saw that in the months of October and November in this very report. October was revised down to 105,000, while November was revised down to 175,000. So collectively, 71,000 fewer jobs for those 2 months combined, showing that perhaps the job market is coming into a bit of a better balance and cooling than what we saw on the top line number this morning. Still, taken together, there is nothing in this morning's jobs report or the latest jobs data that indicates that the Fed is going to cut rates anytime soon. And frankly, guys, if we continue to see such strong job reports month after month, you gotta wonder if they're gonna consider hiking again. Guys?
All right, Yahoo Finance's Jennifer Schomburger, always keeping us on our toes. Possibility of additional rate hikes in 2024. Jen, we'll talk to you later on this hour. All right, tech stocks were the star of the equity market in 2023, but we have started the new year with a bit of a wobble. The Nasdaq has lost ground for 5 straight days, all 3 this week, all 3 so far in 2024. Futures pointing to losses once again at the open. This also coming as Apple getting hit by a pair of downgrades on the street. Joining us now to discuss this and more is Paul Meeks. He's a veteran tech investor and currently finance professor at the Citadel. Paul, thanks for hopping on. I want to talk, just kind of start with what your view is on what we've seen in tech, specifically the Nasdaq starting this year after a more than 40% gain in 2023. Certainly, one had to expect some level of, temperament, let's say temperance of the enthusiasm for investors as we got into this year. Anything concern you in what we've seen over the last couple of weeks, or does it kind of track with maybe how you would see this kind of market rally evolving?
I still am pretty constructive on the tech sector, and I think you nailed it on the head. I don't think we have a fundamental issue. I think the drivers, including the most important driver, artificial intelligence, are still intact as we roll into 2024, but we've simply come too far too fast, particularly with the explosive move upward in this sector ever since November began, that we're probably due for a little bit of comeuppance. But I would wager, and of course I do it for a living, that when we get to the end of 2024, the S&P 500 will have a pretty good year. It'll outperform its 10% long-term average. Not as great as last year, but still a solid year. And the tech sector may not be the top of the class of the 11 sectors, but it's going to be one of the leaders. So the way I look at this is let the profit taking in technology exhaust itself and get prepared to reload on some of these stocks, because I think we're going to do quite well. There's a little bit of angst right now, as Jennifer was talking about, as to the path of rates. Specifically, when will we have our first cut? Does it really matter at the end of the day if it's March or May or June? I don't think so. As rates head down, tech stocks and other aggressive growth stocks should do quite well. So I'm waiting patiently. It's more of a technical call rather than a fundamental call to buy these stocks once the profit taking, and I think that's all it is, and the tech sector exhausts itself.
Well, Paul, talk to us a little bit about that technical part of the call here, just in terms of investors looking to put money to work, maybe buying the dip on some of these larger cap tech names that really outperformed and carried the market in 2023. What levels should investors then be looking at?
So I'm not really a chartist, but I take a look at support on the 50-day, and then after that, perhaps the 200-day moving average. The other thing that's important is you don't have to wait too long, just a couple of weeks before we have another spate of quarterly earnings reports, which should either boost our confidence in various names or make us a little bit more cautious. So I think those are the keys. There is no rush. What you want to do is see these stocks find some support, the trading volume in said stocks start to dry up, and then you'll feel comfortable that the profit taking has exhausted itself.
Paul, you mentioned corporate earnings are coming up. I think starting end of next week, we'll get some of the big banks reporting. I want to get your view on the AI fundamental trade, like the amount of money that is actually being invested into this theme. I'm just curious how you think about the way it differs maybe from, the 2018 blockchain hype, right? And maybe does it compare to what we saw around fiber buildouts, before the tech bubble in 2000? Just curious for your views on that, actual spending we're seeing from companies.
Yeah, I think what happens in 2024, even though it sounds kind of boring to say, is the strong get stronger, because what I see this year is another very aggressive year on spending building large language models. So I don't actually see opportunities until later years for software apps that are cool products that are AI driven. We continue to build large language models, and who does that benefit? That benefits the hardware and particularly the semiconductor names that are essentially making this happen. And so I think it's a legit monster theme. Like anything, though, and I've been doing this a long, long time, some stocks are overhyped right now, and they may not at the end of the day make many dollars off of AI at all. But the ones that are supplying the infrastructure to support, particularly over the next year, building out these large language models, will continue to do quite well. But one of the tells that we'll see this year is Microsoft's Office 365 Copilot. They're asking $30 a month for a base service that only costs half that. If that ends up seeing a lot of pickup from customers, then you'll say, okay, people are going to spend on AI. But that'll be a really important tell. Let's see what happens with the ramp of that product in 2024.
Yeah, and Paul, maybe in 10 years we'll circle back on the companies that actually made a ton of money on AI, but the stock price didn't go anywhere. We saw a bunch of those back in 2000. I want to get you out of here on a name that we haven't discussed all that much really last couple of weeks, which is Meta, stock that was up about 165% or so, I think, in 2023. And if it's possible to rally 160% and be a stealth rally, I think Meta did it last year. Curious what you see as the story there as we get into 2024.
Sure. Now, one of the things you have to remember about Meta is its market cap dropped about 2/3 in 22. So the comeback in 23 was great, but it had a very deep hole to fill. The way I look at Meta is with its strategy with AI being totally open source. I like that. I think they will be a beneficiary of the theme. In the meantime, we should have, unless we have a recession in this country, I don't think we will, we'll have a nice reacceleration in digital advertising. And also we'll get another jump in digital advertising because it's an election year. And Meta should do quite well. I also like Google, but probably Meta more. but it won't have the return it had last year. But I do expect it to outperform and maybe be on the top of the class of the Magnificent Seven in 2024.
All right, some reasons to still be optimistic about those tech favored names that we saw in 2023. Paul Meeks, thanks so much.
Thank you.
Let's take a look at Tesla, because Tesla's self-driving problems are continuing to escalate. The EV giant recalling more than 1.6 million electric vehicles in China. Now, China's state administration for market regulation issuing this recall on Tesla Models S, the Model X, Model 3, and Model Y after raising concerns over its auto steering function and door latch controls. You're looking at losses just about 0.3% here in pre-market trading ahead of the open. So not a huge move in the stock. But Miles, one of the reasons we bring this up is just because the issue that this really points, or maybe it gives investors another reason to be a bit concerned about Tesla, at least in the short term, particularly in China. We had the news earlier this week with BYD overtaking Tesla as the most widely sold EV in the world. So on a global basis, there is some cause for concern just in terms of Tesla being able to produce cars and produce them at a price point that's really going to be a mass market here outside of the US.
Our autos reporter, Proud Supermanian, doesn't need to tell you that I'm not a huge recall guy when it comes to like a story for the stock. But I think, as you mentioned, the China story is really the important one for Tesla as we get into this year. In the fourth quarter, we saw BYD overtake them in terms of sales within China. There's been ruthless competition in the EV market worldwide over the last year around pricing. Now, Tesla's market share, at least in the US, still remains basically unchallenged. It's a little bit of a mixed picture as they go into different geographies. They're a huge leader in a number of markets over in Europe, but you have a lot of, I don't know, this really feels like now is the moment when, in terms of just pure market share, how many people have an EV from maker X versus have an EV from Tesla, could start to get at least a little bit interesting. Now, how the stock acts, I mean, I feel like trying to figure out how Tesla is going to trade based on some of this information, that ship has sailed like many, many years ago. And you kind of, every day I feel like I wake up and Tesla's down 5%, then I look at a one-year chart and the stock's up 100%. So I'm never quite sure how to think about the actual trading in the name. And we are well past trying to figure out what piece of news will be a fundamental driver to get the stock to go up or down. I think the reasons why this continues to be a name that acts well are well established given the investor base, how much money people have frankly made on this. People are becoming millionaires and billionaires just for owning a little bit of Tesla. So that story is obviously one that's outside of this local recall angle. But I do think Tesla's presence in China, how it navigates real challenges from domestic-based producers within China, a huge story for them, not just in 2024, but really I think through the end of the decade as more automakers get towards that, we want to produce, 50% of cars that are EVs by 2030, whatever the number is, and everybody has kind of a target around that. So certainly a story we're going to be tracking.
Yeah, and what that market share looks like, not even inside China, but also here in the US, are already starting to lose it, obviously, as those traditional players ramp up their production.
One day I'll do the thing where I walk around the neighborhood and I write down all the different EVs. You can just tell
Sounds
cars
like a
are
perfect
quieter,
weekend
right? Yeah, we'll take this offline. All right, all your market action ahead. We're about 16 and a half minutes away from the opening bell here on this Jobs Friday. You're watching Yahoo Finance. Let's take a look at shares of Constellation brand stock, up about 1% this morning after the company out earlier with its latest quarterly report, reporting stronger than expected results in its beer segment, a little bit of softness in its wine and spirit segment. Joining us now to discuss these results, Filippo Falorni is a vice president of equity research over at Citi. Filippo, thanks for hopping on. Let's start with what you guys saw in the beer segment here from Constellation. Particularly Modelo brand has been such a strong driver of this story. What you saw in this quarter and how you think about that as a growth driver for them going forward.
Yes, absolutely. Thanks for having me, guys. So look, it was a very strong result quarter for Constellation in the beer business. As you mentioned, the Modelo Especial brand is the largest brand in the beer division, and that grew depletions, which is a measure of volumes, about 12%. Overall, the beer segment grew 8.2% depletions, which was above what the consensus was expecting, and the buy side around 6%. Again, driven mainly by Modelo Especial, but also strong results in the other brands like Pacifico growing 19%, Modelo Chelada growing 22%. So there's a strength in the overall portfolio. Modelo Especial, as I mentioned, is the largest beer brand, and this year reached the #1 beer brand in the US, surpassing Bud Light. So I still think there's a lot of runway for the Modelo Especial brand. When you look at distribution opportunity, there's still less distributed compared to like larger brands like the domestic, like including Bud Light, Budweiser, but also Coors Light and Miller Lite.
Yeah, and you mentioned the Bud Light story, which was such a big part of the beer market in the early part of 2023. Modelo, a huge beneficiary of that, but now that we've moved past maybe the most acute phase of that, what do you think continues to drive Modelo consumption, its rise up the rankings for U.S. drinkers, and maybe just like in simpler terms for our audience, what are the drivers for a brand like? Are we talking getting into more stadiums, getting into more bars, more home consumption? How does that kind of shake out in your view?
Absolutely, absolutely. So obviously the Bud Light controversy this year was probably the most important driver within the beer industry. I would say from a consumer standpoint, though, Modelo Especial didn't see as much benefit compared to like the other domestic brands like Coors Light, Miller Lite. We estimate that those brands capture about 80 to 85% of the share losses from Bud Light. So from a Modelo Especial brand, a lot of the benefit was from a brand recognition. Consumers got to know Modelo Especial better because it was in the headlines. But from a distribution, there's still a lot of runway for the Modelo Especial brand. And particularly as you get into the spring of 2024, to your point, Miles, when you get into getting more facing in retail stores, in liquor stores, but also in the on-premise channel, getting more tap handles at bars, restaurants, stadiums, there's still a big opportunity for the Modelo Especial to gain distribution. And then the last big driver for them is the Hispanic population, which is the fastest growing subpopulation within the US. And that continues to be a tailwind of 1 to 2% in terms of volume growth into this brand, which tend to skew more towards the Hispanic consumers, which are about 50% of the consumer base for the Modelo Especial brand.
So, Filippo, comparing the results that we saw in the beer segment to what we're seeing in wine and spirits, because we did see weakness there, especially when you take a look at the guidance there. Organic top-line growth are now expecting a decline of 7% to 9%, which was down from a decline of 1 to 2%. What are the biggest challenges and headwinds within that sector, and do you see that at all turning around as you look ahead to the next couple of years?
Yes, that's a great question, Shauna. Essentially, beer has been the driver of the company and of the stock. It's 80% of sales and 90% of profits. So the beer business is the majority of Constellation. But the wine and spirit business, as you mentioned, has been underperforming. The main reason of the underperformance is that their portfolio still skews towards lower mid-tier and lower tier brands. They've been trying to divest some of these lower tier brands, but they're still underperforming, particularly in the wine business. Two big brands, Robert Mondavi and Woodbridge, have been significantly losing share in a decelerating category. And then within spirits, the Svedka brand, which is about 90% of the spirits portfolio, that's also been losing share in the category. So that has been a reason of underperformance for Constellation Wine and Spirits business. Yesterday, the company announced in an 8K that their current leader of the wine and spirits segment is stepping down from the position. And so I expect that to be a positive catalyst for a change and try to turn around this business. There's also been in the past speculation of a potential sale of more assets in wine and spirits. And we've been writing in our research that we believe if Constellation were to divest more assets in wine and spirit and focus more on the beer business, that would be beneficial for the stock and for the total business, as beer will become a bigger percent of the mix.
All right, Filippo Fallorini, Citi's Vice President of Equity Research. Thanks so much for joining us here this morning on these earnings results. All right, let's get to another mover, a top trender here at Yahoo Finance. Apple supplier Foxconn. Apple moving today, but Apple supplier Foxconn seeing sales declines again in December, falling over 5% year over year, isn't predicting a turnaround in the current quarter. The data raising some concerns about demand for the newest iPhone model, something that we have heard about a number of times over the last several weeks, but in particular this week when we got the downgrades here from two analysts on the street, started by Barclays earlier this week when they cut their rating to underweight. But what all this means here for some of these suppliers who rely so heavily on Apple's iPhone sales, we're continuing to see some of that pressure here. Taiwan Semiconductor, one of those names here, Miles, that has been under a bit of pressure this week, considering the fact that it gets about a fifth of its annual revenue from Apple. So we're seeing pressure once again on Apple. And once again, some of Apple's critical suppliers falling as well.
Yeah, and the classic names for U.S. investors really focused on the derivative Apple play, let's say. Skyworks, Qorvo, a couple of names that have been down closer to 9%, over 9% over the same 5-day period where we've seen shares of Apple fall 6%. So, I think it is a reminder that when Apple sneezes, others catch a cold, right? To use that old cliche. And we see that here once again with these names. But I think the question for the overall Apple ecosystem is no one doubts that they're going to continue to sell millions and millions of iPhones, and that they're going to continue to be the dominant player, at least in the U.S. market, in terms of handset share. And I know we're going to get into this as we get towards their earnings report at the end of this month. It might be the beginning of February, when we have Dan Howley back on set. But it comes down to what's the hardware innovation timeline for them. We know that the headset is really the main driver in terms of hype, like a new piece of equipment for Apple people to get, Apple consumers, and of course the Apple fans to get really excited about as we get into this year. We've seen the services business continue to be the main driver in terms of revenue growth, though it's a smaller overall line item on that top line. It grows faster than the other segments. We had the watch problems at the end of last year. I know they've found some interim solutions to that, but are they creating a new business line around AirPods? I think AirPod Max have been somewhat disappointing. Mine are fine, they fit okay, but I think what they've done with the Beats business, there are a bunch of different questions here just around like your Apple stuff. And, this gets into like the old, what do I know thing. Every iPhone's kind of the same. But I'm just a guy. And I think that, just a guy is the majority of Apple consumers. So
yeah, exactly.
And that's my defense of me.
Well, it's not too far off from what the argument was from Tim Long there at Barclays, just in terms of the fact that there's not a heck of a lot of excitement about the iPhone 15. We certainly did not see the number of crowds or the number of sales at least expected that we had initially hoped for, many investors had initially hoped for going into this launch. And then he also brought up the fact that looking ahead to the iPhone 16, at least from his checks, he doesn't anticipate it to be a heck of a lot different than the reception that we're seeing this time around for the latest model. So taking all of that into account, the fact that it's still so reliant on this one piece of hardware, yes, they are diversifying their business, but the fact that it is still so reliant, clearly a headwind, at least in the immediate term, when you take into account the valuation and the run-up that we see in the stock.
Yeah, and look, biggest company in the market. That's why we talk about it all the time.
It is.
That's another defense of us. All right, let's take a look at shares of cruise liners. Carnival and Norwegian, pair of analyst calls over at Wells Fargo on these names out this morning. Madison Mills live on the floor of the New York Stock Exchange with more on this. Maddie.
Yeah, I was just looking. It looks like Carnival is the top performer in the S&P 500 so far today. Obviously, the market not open yet, responding to that big jobs number from this morning. But so far, looking like a good day for Carnival. That is after Wells Fargo raising this name to overweight with a $22 price target. And the analyst, by the way, who did this upgrade has a really strong record. If we look at his returns, a 42% return for those who followed his recommendations in the past year. So pretty good news for him there. Having said that, some of my sources here at the stock exchange telling me that because of the amount of debt that Carnival has, this jobs number could be bad news for them, right? It could be a sign that the Federal Reserve is going to have to keep interest rates higher for longer, as we always say. And for a company that has a lot of debt on their balance sheet, that is not going to be good news for them. Now, Wells Fargo saying that the fact that they are sort of dealing with that debt finally is potentially a hedge against some of that interest rate news coming in today. I also quickly want to touch on Norwegian. Wells Fargo downgrading this name, a price target set to $18. That's a 2% move from the last price. I did also notice on the terminal that there is a sell, one single sell on this name, and we never get to see a sell. So I was very excited about that, guys. Having said that, a little bit of a mixed picture here. 58% holds, 36% buys on Norwegian, but still not doing so well in terms of their performance today for that cruise line.
Certainly not. And even over the last just 5 days alone, off just about 13%. All right, Maddie, thanks so much. Keep right here on Yahoo Finance. Much more of your market action ahead. Stay tuned. And there's the opening bell on Wall Street as investors digest the December jobs report that we got just about an hour ago. We've seen obviously some downward pressure in the markets here this morning ahead of the open as we shake things out. We're seeing a bit of a reversal there, at least right at the open. Major indices just around the flat line. Maddie, we have team coverage for you here. We have Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange. Jared Blickery standing by at the Interactive. Maddie, lots of excitement down at the floor this morning, and lots of guys, we don't have Maddie on the floor of the New York Stock Exchange, so we're going to kick it off with Jared. Jared, you're not the second option here. You're a first option.
We're talking about the guests on the floor.
We haven't talked about the guests on the floor. I know there's a lot.
That's a great opening
We've heard that
bell.
there's guys with cowboy hats down at the floor. We wanted to get to Maddie to figure out why, so we're going to have to wait for that. Let's get over to Jared with some of this morning's news. Jared.
I'm on pins and needles. I'm with you guys. I want to find out what's going on down there. But let's take a look at the markets. Dow opening up in negative territory. The other two majors, NASDAQ and S&P, just barely positive. But let's take a look at the 4-day performance here. This year, we have seen very little green. You can see we're down about 0.7% in the Dow, and the NASDAQ down 3.3%, given all the weakness in tech stocks, giving back a lot of those gains we've seen from last year. That's been one of the dominant forces here. Also want to quickly check in on the VIX. It had been heading a little bit higher, but you can see it's off of its highs right now. Still, below 14 is a pretty boring VIX right now, and that's what investors want. Here's a 10-year T-note yield. I'm going to put a 3-month chart on this, and you can see it's up about 6 basis points. But one of the things I've been tracking is the defensiveness as reflected in the sectors. And today we see energy and tech and communication services. Those are in the green. Let me show you what's happened over the last 4 days. It's been healthcare, energy, utilities, and staples. Pretty defensive setup there for those to be leading. And then you take a look at the number one sector from last year, tech, it's down 4.1%, along with consumer discretionary, which is retail. So all in all, and let me just highlight this further by showing you the leaders here. We got Bitcoin, cannabis, and low volatility. Those are the three themes that are in the green this year. But you take a look at over the last 2 months, there's been a lot of money chasing the fringier parts in the market. So this is a dramatic reversal in tone. And the question is, how long does it last here? And we don't know that. I'm going to go back to an intraday view of the NASDAQ 100. NVIDIA is standing out. That's up 1.3%. Costco up 1%. And let me just get a quick check on the Dow here. And we can see, there we go, kind of a mixed board for the most part. I'm not seeing any big outliers. I'm going to go back. I just want to chart something interesting in the sector action. I was noting the defensiveness that has kind of popped up recently. This is healthcare versus tech, and tech is up 1.6, or excuse me, tech is down 4% this year. Healthcare is up 1.65%. This is a dramatic reversal from months prior that I'm going to keep a close eye on as we head forward here, guys.
All right, Jared Blickery at the Wi-Fi Interactive Touchscreen giving us a view of the markets. Down on the floor of the New York Stock Exchange, we do have Yahoo Finance's Madison Mills. Episode of Yellowstone breaking out there on the floor, Maddie. We've got professional bull riders in the house. They've gotten 3 mentions now on our air. What are you seeing as we get this trading day underway in reaction to that better than expected December jobs report?
Yeah, besides the 50 cowboy hats that I saw cross in front of my camera in my last hit, looking at a little bit of the movement that we're seeing off of that jobs data, obviously seeing some movement in yields, but that's not necessarily going to be great news for stocks. Having said that, some of the folks that I've been talking to here this morning saying that wage gains can be good for stocks, right? Maybe this means that some of the purchasing power and pricing power, rather, that some of these big names had anticipated losing because of the Fed cutting back on interest rates could be retained throughout the coming year. And that is going to be something that we're going to have to wait until earnings calls to hear a little bit more about. But when we look at the individual sector movement, I got to look at the Magnificent Seven names struggling this morning. Now, we don't necessarily know if that is related to this jobs report or if that's a continuation of what we saw earlier this week with that double hit to Apple, the biggest market cap in the S&P 500 and across a lot of the indices. That is obviously going to lead to a hit to the broader market, and that is probably why you guys we're certainly not going to see another record-breaking week of gains in the S&P 500. Looking at that closing in the red this week as we head into the rest of the trade today.
All right, Maddie, thanks so much. Let's get to our market commentary of the day, because this week, while investors have been pouring money into cash funds at a record-breaking pace, typically the first week of the year does see high cash inflow, but investors pouring over $123 billion into cash funds, making it the highest ever. To break it all down, Josh Schaefer's here with the latest data that we're getting from Bank of America here this morning. Josh.
Yeah, Shauna, so that's the best first week we've ever seen, right, to go into money market funds. And then when you take a look, this is a chart from Bank of America's Michael Hartnett, and when you take a look at just cash into money market accounts. You'll see it was the biggest inflow since March 2023, which I think we can all remember why people were probably putting money in cash at that point. That was the regional banking crisis, right? And I think one of the broader takeaways here for me is when you read through a lot of 2024 outlooks, a lot of market bulls said, well, look at all the cash on the sidelines. At some point, this cash on the sidelines needs to go to work, right? And when that money goes to work, that could be good for equities, could be good for whatever area of the market they want to highlight. Well, to start the year, stocks are down and people are still piling into money market funds. So at least through 5 days, we're not quite seeing that trend play out.
Yeah, I mean, I think what I love about flows data is that it's a reminder that all of the action that we see in the market on a daily basis, like the actual change in the S&P, et cetera, it's all created on the margin because most money that goes into the stock market has already been spoken for, meaning like the majority of it is the three of us putting money into our 401k and we say you have to buy this, right? Yeah. So you got to buy the S&P 500, so you got to buy all these stocks in this proportion, you got to blah, 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 blah. And what we see with you can kind of step back and look what we saw in December, where you started to see a little steam come out of the market at the end of the year, and everyone says, well, you're just window adjusting the portfolio. You want to make sure you actually get the money in hand if you have these gains, and now you got a bunch of cash. So what do you do with the cash? Well, I don't have any good ideas yet. It's still the first week of the year. Let me put it into a money market fund because now I can actually get a little bit of something for a small amount of time by putting it somewhere, and then you start to get these gaudy numbers around, largest first week ever, biggest since 2023. On the one hand, it's a signal. Oh no, people are worried about, the market, this, that, the other. On the other, to me, Josh, it's kind of just, well, if you don't have a better idea, now you get something with your money market fund. That wasn't true for almost a decade.
Well, and that's the other sort of side to this chart we didn't bring up too, right, is bank deposits are coming down right now, right? And people are going to money market accounts just instead of having money in their bank and making less than a 1% rate when you can make closer to probably 5% right now in a money market. That's a different chart that we're not necessarily talking about today, but that is a trend in the market that was happening in 2023 and is probably going to keep happening in 2024 because after that jobs report today, I don't know if interest rates are coming down anytime soon. So it certainly, one could argue, maybe makes sense to stay in cash maybe longer than what some strategists were telling us, say, even a month ago, right? Everyone's call was, well, rates are going to come down, time to start looking to get out of cash. What if we do actually stay higher for longer and then you stay in cash?
Yep. All right, Josh Schaefer, the breakdown of where we're seeing money flow to start 2024. All right, well, investors are eagerly awaiting SEC approval for Bitcoin ETFs. Those are expected out next week. But outside of this event and away from the huge rally we've seen in the crypto space over the last several months, our next guest thinks the investing world is still not bullish enough on crypto as 2024 gets underway. Gautam Chugani is Bernstein's managing director and senior analyst in the digital asset space, joining us now to discuss. So Gautam, let's start with SEC approval, Bitcoin ETFs, your view on that. I guess the questions you get from clients, how you're having folks think about this event for the overall crypto space.
We do think we'll get the Bitcoin ETF approval by next week, hopefully. This is obviously a significant event, right? Because you're going to see funds flow from the traditional markets to the crypto markets. And this has usually been a challenge, right, given how challenging the exchange space has been for crypto. We've had accidents in the past. We've got this massive fraud that happened in 2022 with FTX. So safekeeping and custody and sort of better user experience has always been a challenge with Bitcoin and crypto. So I think the ETF is a good start. We get to see regular people be able to safely custody the Bitcoin without worrying about safety, and I think that's quite significant.
And thinking about the role that retail plays in the crypto market overall, what have you seen from those investors in the last few months? How do you expect those investors to play a role in the market in 2024? Because it felt, at least to me, and maybe this is, maybe I'm wrong on this, it felt like late 22, early 23, that enthusiasm from retail really came out of the crypto market, and it feels like it's come back in a big way just in the last few weeks.
Yeah, for sure. So I think when an event like FTX happens, and obviously you saw many other bankruptcies with Celsius and Voyager, that directly hurt investor confidence, particularly retail investor confidence, because those were the ones that were mostly invested. Obviously, institutions didn't play that big a role in the last cycle. I think what's changed, in this cycle versus any other previous cycle, institutions have always been laggards in any crypto market, any crypto bull market. this time, actually, institutions have led the market, right? So the first news that came in June was the BlackRock filing of the Bitcoin ETF, and that was a big signal that went out to everyone else. And obviously, multiple other ETF applications followed, first with Bitcoin and then with Ethereum later in the year. So I think those two signals were very strong from an institutional standpoint, and even within for us as Bernstein, we've seen this play out where the overall retail sentiment was weak through 2023, but when it came to sort of large institutional clients, we were seeing that interest come back. So it's a different market, it's a different cycle. I think retail wanted that confidence, and now that institutions are leading it, now retail can come out in full force and feel confident about it. And this time they don't have to worry about custody and safety, which has obviously been one of the biggest challenges of crypto.
Yeah, certainly. And Gotham, when we take into account the run-up that we've seen in the price of Bitcoin and the price of a number of these crypto stocks there, how much of this has already been priced in? And when you take into account the other drivers, the other catalysts that you see here on the horizon for Bitcoin, what do you think then what that upside looks like?
Yeah, so I think there's been a bit of run-up, I think probably about 25% in the last 2 months. Clearly, that's not, what we call, the event being priced in. Maybe the event of approval is priced in, but what really needs to be priced in here are the flows. So we do expect significant flows, maybe a bit slow initially, and takes a bit while to for the ETFs to integrate with the advisors and for it to become part of usual portfolio allocations of wealth managers and so on and so forth. But as the year progresses, I think we expect closer to about $10 billion plus in this year itself, kind of flowing into the market. I think we are being a tad conservative. And then obviously in the following year, we do expect overall about 10% of Bitcoin circulating supply to be custodied under the ETFs. And obviously that's quite significant. That's quite a significant number, which will mean, hundreds of billions of dollars of flows kind of playing out over the next 18 to 24 months.
Gotham, I think a lot of people are sitting at home listening to at least your forecast. They're very optimistic about what that pricing action could look like then between now and the end of the year and beyond. So what do you think are the top ideas or your top plays for investors at this point to really capitalize on some of that optimism that you see coming into the market?
Yeah, sure. So I think this year, the significant event after the ETF is going to be the halving. Halving is a significant event from the point of view of the fact that, the sell pressure is going to kind of be cut into half starting April 2024. The miners own Bitcoin and then they sell it in the market. And that's obviously known that this is going to happen in April. But when you combine that with the demand catalyst, right, the demand that's coming from corporate treasuries, obviously with something like MicroStrategy, but it could be even other corporate treasuries given the change in the FASB rules around how you account for Bitcoin on the balance sheet. And then as the ETF builds up, that's obviously another significant demand catalyst. So when you combine that supply from halving with the demand, that's where our bullish view comes from. And that obviously leads to, our forecast there. In terms of ideas, what we like are the Bitcoin miners. So we covered 3 names, Riot, CleanSpark, and Marathon. We have an outperform on those 2, which is Riot and CleanSpark. And there, obviously, it's interesting because we see miners as a high beta way to kind of play the Bitcoin cycle, given as the price improves, their revenue improves, that leads to operating leverage. And then obviously late into the cycle, you start to see their price multiples expand as well. So we do think that if Bitcoin, what we are saying goes to 150,000 in the cycle high, we think miners will do more than that, will outperform Bitcoin.
All right, Gautam Jagani, thanks so much for joining us here this morning. Bernstein's analyst there. Thanks so much.
Great, thank you.
Well, we've got all your market action ahead. Stay tuned. We'll be right back. All right, Jefferies downgrading Palantir this morning, lowering its rating to underperform from hold, slashing its price target to $13. That's down from $18. Now, the analyst there, Brett Thill, saying that the company has seen, quote, unsustainable valuation levels on the back of AI euphoria. But he did reiterate that long-term Palantir still has an AI technology advantage. Miles, we know this is a stock that has had a massive run-up over the last 12 months. Last year alone, the shares gained just about 160%. But we're bringing up this call. Yep. Obviously, it's a market mover today, one of the trending tickers here at Yahoo Finance. But comparing this to what we heard from Wedbush's Dan Ives yesterday. He was on our afternoon program, part of our Buy or Goodbye segment, talking about the fact that he loves Palantir and making a pretty bullish case here for the company going forward.
Yeah, we talked about it a little bit with Tesla earlier on in the program about how it's one of these names where you can never quite figure out exactly what the fundamental driver is versus the sentiment driver just around the stock price itself. And Palantir feels like a very similar name. If you look at the stock's history, it was one of the, I'd say it's a top 10 meme stock back from that 2020-2021 period. The stock at one point was trading in the mid 30s. I think its high close was somewhere in the mid 40s. We see it here about $16 a share today. Now, because it doubled last year, we can do the math. It was in the single digits as we got into 2023. So, on a technical setup, I'm sure Jared would tell me all about the different gaps that can be filled. Is it good that it's consolidating in the mid-teens? Is that poised for a breakout? All this kind of stuff. And honestly, that feels like more of the story for Palantir than the fundamental case about where the business goes, how it benefits from AI. It's essentially where the stock is trading where it was trading, almost 4 years ago now at this point. And it's a much more interesting trade. Not that the company itself isn't interesting, but I think the way it's levered to government spending, it has plenty of opportunities within AI. But I think it's very challenging for any analyst, whether it's Brent Thill at Jefferies, Dan Ives over at Wedbush, to kind of sort out the story between the business and the stock. And it's a fascinating stock, but it's very challenging, I think, to one for one say like, oh, this deceleration is definitely, I think on just a this got ahead of itself basis, I think Brent's call is sort of the safer one. It's like, well, $9 last year, now it's at 16. Maybe it won't go up forever. But it's just a very challenging story to sort out.
Yeah, and he pointed to the fact that the chart that we just had up there on the screen talking about some of the deceleration that we did see in his business. He used that just to validate, or I should say back up, the valuation call that he's making. The fact that shares have run up so dramatically over the last 12 months. We're up 167% in 2023. And comparing that to some of the fundamentals, at least that we can see from some of this transparency into their business, we are certainly seeing a bit of a deceleration in the commercial business, also in the government business. So he's pointing to that, saying that that's a concern, at least for the short term, and it's resulted in maybe a longer than expected recovery than many analysts had maybe initially, at least Brent Thill had initially been anticipating going into this. But it's an interesting stock when you take a look at the moves that we've seen not only this year, but like you're saying, going back to the last couple of years. And the fact it wasn't that long ago when it was one of those meme plays that we would consider.
You looked at the bull and bear case, bull case. Possible inclusion in the S&P 500 on GAAP profitability. Saw that with Uber last year. That's one of my favorite stories. Stock goes up because it's added to the S&P. We'll see if it comes through. It's a great story about the mechanics of how the market works. All right, take a quick break here. All your market action ahead on this Jobs Friday. All three major indexes now in the green.
Live, I'm Jennifer Schonberger. Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger here in Washington at the Labor Department, where this morning's jobs report came in much stronger than expected. 216,000 on that top line non-farm payroll number, with the unemployment rate holding steady at 3.7% and wage growth coming in stronger than expected at 4.1%. For more insight on this morning's jobs report, I want to welcome into the program Acting Labor Secretary Sue. Secretary Sue, thank you so much for joining me. Happy New Year.
Good to see you again. Happy New Year, Jennifer.
Good to see you. Interest rates at a 23-year high, and yet the job market continuing to surprise to the upside, yet the labor force participation rate dropped. Why was that, do you think?
Right. So these are December numbers. So let's just take a moment to recognize what happened in 2023, right? The 216,000 jobs created in December were part of a monthly average over the year of 225,000. At the same time, as you noted, unemployment remained under 4% for 23 months straight, almost 2 years, really defying all expectation. We also saw throughout the year labor force participation rate come roaring back, right? Roaring back after the pandemic. We saw it. We've talked about this here about women, right, coming back into the labor force, it reflecting both like confidence and a desire to work and ability to find jobs. And those were all part of the Bidenomics approach to an economy in which we can build the economy back through good jobs by investing in America. We can do right by workers by making sure that there's enough breathing room, right, enough wages to live on, and we don't have to have those things, you know, by sacrificing worker well-being. And so all of those things, I think, it's that coveted soft landing that many people predicted would not be possible. And so we look back on the year and say, you know, policies worked. They didn't happen by accident, and we've got more work to do in 2024 to keep it up.
But why do you think the labor force participation rate fell back?
So I think there was a tick down in December after, again, these historic highs that have come back in, right? But not in any way that's concerning. You know, these overall throughout the year and also in December, right? The overall numbers are reflective of strong and stable growth. And of course, we have more work to do. Of course, we want to make sure that everybody who wants to work can get a job and get a good job that offers them economic security, right? Dignity, you know, a job in their community so they don't have to commute really far to do it. All of those are part of our vision for 2024, building on the successes of 2023.
So then how does this forebode for the job market outlook for 2024?
So 2023 was a big year for working people. Right? Big gains at the bargaining table, right? Higher wages, as you noted, you know, more retirement security, stronger health and safety protections. You know, we saw job growth across multiple sectors, right? So government was strong this past month, but leisure and hospitality has been up, construction has been up. There's been over 800,000 manufacturing jobs created since President Biden took office, and most of the investments that he's helped to make possible are still just hitting the streets. So 2024, you know, we say, you know, is going to be our best year yet because policies matter, leadership matters, and we're going to be building on the strength that we have seen month over month in 2023.
Fed Chair Powell said in December during his press conference that he thinks that the era of frantic job shortages are behind us and that we're seeing job openings come back to a more normalized level. Do you agree with that? Or do you think there's more that needs to be done for the job market to come back into balance?
I think the idea of things normalizing is a good way to paint what is happening. But they're also normalizing in a way that President Biden said was possible and many people thought was not, which is record job growth, right? We're 14.2 million jobs created, combined with record low levels of strong, sustained unemployment, combined with wage growth, right? All of these things, and currently, right, wage growth that is outpacing inflation so that workers really feel it in their pocketbooks. Families can feel some more, some more financial security. So yeah, this is the, you know, Bidenomics in action, right? It's the idea that we can build that kind of economy. We've seen it happen over, you know, incredible recovery since President Biden came into office. And looking over at 2023, I think it, you know, the numbers answer the question. And we want to continue that steady, stable growth in jobs at not the breakneck speed that we saw in 2022, but more at the pace that we saw throughout 2023.
Switching gears, I want to ask you about artificial intelligence because there are a lot of concerns about this in Washington, about hiring biases being institutionalized, job killing. The Labor Department recently held a forum back in December on the pros and cons of AI. What did you learn, and how is the Labor Department prepared to ensure that AI can help actually boost the job market?
Right. So we confirmed a few things that we thought, right? One of which is that there is nothing inevitable about what AI is going to do. Everything we do are policy choices that we have a chance to make right now, and we want to make in conjunction with industry, right? Across government. The president's executive order is about a whole of government approach to making sure that we harness the benefits of AI and really make sure that we curb and limit any of the harms, right? And some of those harms, as you noted, are algorithmic bias in the adoption of AI. AI is only as good as the people who build it, and we live in a society that still has bias. We don't want that to be the future of AI. Job displacement, right? There's nothing inevitable about that. People have been talking about a robot apocalypse every time there's evolution in technology, and those are choices we can make. And what we've seen also throughout 2023 is that when workers have a seat at the table, when they have a voice in helping to figure out how will AI be deployed, how will AI be used, how can AI be used to improve workers' lives rather than to hurt it, it makes a difference. The Writers Guild, SAG-AFTRA, right? They bargained over it and found ways to protect their jobs and the future of their industries when it comes to AI. I was just with the vice president in Las Vegas. We were meeting with culinary workers who bargained around how AI will be used and how much information they get about the adoption of AI and how they're going to be a part of designing that future in the industry. So we think that AI has the potential to do good things and the potential to do bad, and which one we choose, is very much a choice.
And then before I let you go, I do want to ask you about women, the workforce, in childcare. So I have in my notes here, according to Bank of America, the average child care payment per household has risen 30% since 2019, with middle and upper income families, these are families that are earning $100,000 to $250,000 a year, seeing the biggest increase. And the investment bank says this is driving parents out of the workforce. We actually see fewer dual income households now than we did in 2019. So what is the administration prepared to do about this to boost participation in the workforce?
It's such an important question. This is why President Biden has said from day one, we have to make sure that we build our child care infrastructure along with all of our physical infrastructure, right? This is something that dramatically affected labor force participation during the pandemic, right? We certainly saw that. But we also know that if we do not address child care needs, and frankly, this expands beyond child care, right, to elder care, we have an aging population. So if we don't address those, it is going to have a dramatic impact on the ability of women in particular to participate in the labor force. In fact, the Department of Labor recently put out a study that found that if the United States invested in childcare and other family-friendly policies like paid leave in the way that other comparable developed countries do, if we did that, it would drive economic growth to the tune of billions of dollars. It's a cost of doing nothing report, meaning if we don't do it, it's costing us as a country about $775 billion a year. So, people often talk about the cost of childcare. We also have to think about the cost if we don't do enough. And so that's why we are so focused as an administration on doing everything we can within our power to really build up the childcare infrastructure and to support childcare jobs so that they're also good jobs, because they're also overwhelmingly done by women.
Yeah, I mean, to your point, in that report that you're referring to, the labor force participation rate for women in the largest 15 countries, when we compare the U.S., we're dead last. But we'll have to leave the conversation there. Thank you so much for your insight, as always, Secretary Sue. Look forward to speaking with you
so
next
much,
month. That's Acting Labor Secretary Julie Su. We will be right back after this.
back to Yahoo Finance Live. I'm Shauna Smith alongside Miles Udland. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up. We are seeing green across the screen. All three of the major averages trading to the upside for the day following that better than expected jobs report. Now for the week though, all three on track to snap their 9-week winning streak.
All right, let's take a look here at some individual stocks we're keeping an eye on this morning. McDonald's stock dipping in early trade, off about 0.6% following a downgrade from analysts over at Oppenheimer. The firm says they expect a tougher setup for same-store sales growth in 2024. The company saw double-digit EPS revisions in 2023, and Oppenheimer does not see another round of catalysts supporting that kind of growth in the new year.
Well, PayPal shares taking a hit today on a downgrade from BTIG. Now the call coming just a few weeks into the new CEO's leadership. BTIG warning that PayPal's return to consistent profitability and revenue growth as a multi-year initiative, not a 2024 story.
And Exxon reporting in a regulatory filing this morning, it's expecting impairments of $2.4 to $2.6 billion in its upstream business related to idled assets in California. Stock up about 0.8% in early trade. Company said that challenges in the state's regulatory environment have hurt progress in restoring its operations, a warning similar to what we heard from Chevron earlier this week. Well, Netflix is evolving its gaming strategy in the new year. The Wall Street Journal reporting this morning the company is weighing how to generate some revenue from its gaming services in 2024. Stock up about 0.3%. Currently, Netflix gaming is free to all subscribers. Now the company may be adding in-app purchases or even charging for some of the more sophisticated games on the platform. Feels like Netflix, anything, sports, live events, gaming, Shauna, has been a conversation for many years now. Are they going to find new ways to generate revenue? They kind of just went from 0 to 100 with ads in about, 9 months maybe. And that's been, a successful lever for them to pull from the subscriber growth perspective. We've seen that the last couple of quarters. We've certainly seen that, kind of get investors excited once again in the core Netflix story, which is essentially taking more and more market share in how people spend time with screens in front of their faces, which is, how people spend most of their time these days. The gaming one, to me, I don't know, generate revenue, like it's just less interesting to be like, we would like to generate some revenue from this compared to, again, the success they had with the ads business. Yeah. And I do sort of wonder if, Netflix wants to say we're continuing to innovate in our product roadmap, but it feels like they kind of found the answer, at least for the near term, with the ad-supported tiers.
Yeah, I do agree with that, and especially just because of the fact that when you take a look at the numbers, at least released from Apptopia and some of the other data firms that track at least what they think the user base looks like, it only accounts for about 1% right now. Gamers account for about 1% of the users, so very, very small fraction. So exactly to your point in terms of how big of a revenue driver this is going to be, at least in the medium term or immediate term, I should say, given those low numbers. Clearly not going to be anything that investors are going to really change their investment thesis on. But I do think it points to a fact that if this is relatively easy or an easy hurdle here to get over, able to monetize something that people are starting to use that's becoming a bigger story within the Netflix playbook here going forward. We've heard executives talk about this time and time again, just their emphasis and what they look to see in terms of growth opportunity here for games. So now they look to monetize it. It's obviously further diversifying the revenue stream, adding another source of revenue here. In the immediate term, though, nothing huge. What these numbers could look like maybe in the longer term, again, unlikely to ever be in comparison to what we've seen from the ad-supported tier, but it could be another reason for investors to be more bullish on this.
Yeah, I mean, I'm first I'm hearing there's a too hot to handle game.
Yeah, I was going to say, I've never played the game.
But it's like, I guess maybe I'm not being, excited enough about the support, but it is kind of like media empire building 101, right? I mean, it's the Mel Brooks bit from Spaceballs, right? We're going to do the lunch boxes, then we're going to do the games, we're going to do the licensing. So you have a show, it's successful, you make a game, you do a bunch of other stuff. And so here we go. And you charge money for it. You make money from it.
Yeah. So why not? If you're doing it and people are playing games, even if it's a small number of games, monetizing it, you're gonna make more money.
It's just business.
Business 101. All right, let's move to the jobs market. Our big story of the day: the December jobs report coming in hotter than expected, with growth in government, healthcare, and social assistance construction leading the way. So how is this translating to employee sentiment? Well, for that, we want to bring in Daniel Zhao. He's Glassdoor's lead economist. Daniel, it's great to have you here on set with us. Let's talk about the numbers that we saw in this jobs report. Yes, that headline number was strong, but there were certainly some data points to be a bit concerned about. Labor force participation slipping just a bit. How does this compare to what you're seeing on your platform?
Well, yes, I do think that the jobs report is actually a little bit of a mixed bag under the hood. We saw payroll growth was very strong, but labor force participation came down a little bit. Employment from the household survey came down a little bit. On the flip side, we are seeing on our platform that employee sentiment is starting to pick up. It's increased for the third straight month in December. It's still down significantly compared to where it was a year ago, but hopefully that gives us a little bit of optimism heading into the new year, that employees are feeling a little bit more comfortable about their job security and the risks of a recession in the new year.
And I guess maybe just take a step back. How do you guys kind of calculate that employee confidence? And then maybe when you look as an economist at just kind of the setup of the headline numbers from the labor market, how does that, what is that employee confidence indicating relative to kind of those more mainstream data sets, let's call them?
Yes, so employee confidence, we basically just ask employees like how confident they're feeling about the business outlook for their employers over the next 6 months. And then we do some calculations. We
like
make
a
sure
differential, good versus bad kind of
Yeah,
thing?
essentially,
Okay.
right. And so when we look at that data, really what we want to get a sense of is like there's these business confidence measures, consumer confidence measures, but how are employees feeling? Because they have a pretty good pulse on how businesses are actually doing. And when we look at that data, we think that it signals a few different things. It signals how those businesses might be doing financially, for example, but it also might tie into other labor market indicators like the quits rate. Because if you're feeling particularly good about your employer, well, you might not want to quit. And conversely, if you feel really good about the economy, but not so good about your employer, you might decide to quit to look for a better opportunity.
Dana, when we talk about who has the upper hand right now, we talked for so long that it was the employees throughout the pandemic, given the fact of the situation that we were in. Has that now reversed? And I guess in terms of that smaller headcount that we've heard so many business leaders talk about over the last several quarters, when they talk about more reliance on efficiency, looking to streamline their business, what impact then does that have to the employee?
Mm-hmm. Well, I don't think it's fully reversed. I think that the labor market is still fairly hot, but it's definitely more on a case-by-case basis now, right? So this isn't 2021, 2022 where you could throw a stone and find a job opening, right? So
for a 20%.
Right. So for now, it's a little bit more. Job seekers have to do a little bit more research to find those industries or those parts of the industries that are still hiring, that are still looking for workers, and you probably aren't getting quite the same raise that you would get just a few years ago. But at the same time, this is still a fairly strong labor market. Unemployment is still low. There are still those opportunities out there. It's just a little bit more selective.
I'm curious how you think about, again, working at a firm like Glassdoor, and we see, LinkedIn has an economist team, Indeed. How you think about the JOLTS report in the context of the work that you guys all do, looking at your own platforms, because it doesn't come up too often, but every so often there's like, well, are we sure we know how many jobs are really open, all this kind of stuff? I'm just curious how you think through that, the way the BLS adjusts it, what you guys see on your platform, and what that data set's been telling us about the labor market.
Well, the BLS does absolutely fantastic work. They are really the gold standard in understanding what's going on in the labor market, and we like to think of ourselves as providing supplementary data, right? Like we can provide a view into maybe how employees are feeling, or maybe some of the things that they're talking about in their reviews that you can't really get from just like a plain old survey, right? And so we're hoping that can provide a little bit of additional context to those BLS numbers, but we're definitely not trying to replace them or anything.
Dana, what are you seeing just from a skills shortage standpoint? That was a story that we had talked about for so long, kind of getting buried at this point.
Throwback.
It's
2017
but I bring this up though just because of the productivity issues, or I should say concerns going into it with the development of AI, exactly what impact that's going to have on the workforce. Is that further exacerbating maybe the shortage that we had going back a couple of years?
I think the skills shortage narrative tends to be a little bit overblown in the sense that a lot of people underestimate how transferable their skills are. And certainly as we're talking about kind of what skills are going to be important in the future, I think soft skills are still going to be extremely important. It's not just about having a STEM degree nowadays. Those soft skills will still be important, that person-to-person interaction. I don't think that AI is really going to fully replace. So I think that those are skills that are applicable across industries. And even those hard skills too, I think a lot of people say oh, tech is going through this slowdown, but those tech skills are just as valuable in healthcare or in finance or in other industries where hiring might be a little bit more stable.
Another win for the liberal arts. We love to see
Huge
it.
win.
Love to see it on this program. All right, Daniel Zhao, Glassdoor's lead economist. Thanks so much for stopping by.
Thanks.
All right, let's take a look at the markets here as we head to break on Yahoo Finance Live. We see all three major indexes in the green on this Jobs Friday. NASDAQ leading the way higher, up about 0.5%. We're back with more right after this.
Chinese stocks sliding this morning after wealth manager Jiangxi Enterprise filed for bankruptcy. Now, the shadow bank struggling to keep up with its debt after lending out billions of dollars to real estate firms for almost 30 years. Yahoo Finance's Jared Blickery is at the Interactive with more on some of the moves that we're seeing. Jared.
That's right, Shauna. This has echoes of Evergrande. Remember that? That was a property empire that collapsed a few years ago in 2021. But guess what? It never filed bankruptcy. It's still restructuring and limping along and trying to avoid that eventual liquidation. But another company, Jiangxi, as you were saying, has bought some of its assets along with a lot of risky assets from another bunch of trusts and real estate ventures. And those are souring right now. So its very risky attitude is being rewarded rewarded with bankruptcy. And this is a little bit of a surprise for investors because they thought, going back a few months, there was a government inquiry into this. They thought, well, maybe we'd be able to avoid liquidation and there would just be a little life stream put out to the company. But no, bankruptcy is the case. And it looks like the investors in the company, the equity holders, are going to lose about 75% of their cash. This shows you how big this company is. Here's the affiliate entity right here, worth about 629 million yuan, which is $90 million. Not a huge amount, but you can see the Chinese property sector is actually quite a bit bigger with some of these other entities. And so the question of contagion now rings true and maybe brings back some memories of Lehman Brothers. Is this going to be Lehman on the scale that we saw in the US? I don't think so. But just to show you just the commonality there is that a lot of investors thought that Lehman was going to get that bailout. Did not happen. This is all important because Chinese government has been feeding the private sector. It's been kind of letting it limp along based on very, very targeted stimulus in certain areas with very careful consideration not to stimulate the entire economy too much because that devalues the currency, that encourages capital outflows. That's what they don't want. But this chart right here shows social financing as a percentage of GDP going all the way back 20 years. And you can see it was plateauing here. China was a different economy back then, accelerated in the global financial crisis, had another acceleration here, and it's been on a much shallower trajectory. But if it were to go up like that again, I think that would be something that the Chinese government is trying to avoid. But another thing they've been trying to avoid is their budget deficit increasing beyond 3% of GDP. And they allowed that to happen last year. So they're breaking their own rules to accommodate their weak economy. Final chart here, Chinese GDP 1992 to 2023, 4.9% is probably a hallucination by the government there. Look for that to become significantly weaker this year. A 3-handle, maybe a 2-handle, we'll have to see in the years to come. But the Chinese government really has its work cut out for it. This is a big warning sign.
All right, Jared, thanks so much for breaking that down for us and the risk that we're seeing there. We want to get back here to the U.S. and some of the data that we're getting out this morning, having an impact on the market trading here. The U.S. services sector slowing in December. The Institute for Supply Management saying that its non-manufacturing PMI falling to 50.6 last month, the lowest reading since May, down from 52.7 in November. Now, we did also see a measure of employment dropping to the lowest level that we have seen in nearly 3.5 years, the lowest that we had seen since July of 2020. So some of that weakness there, similar to what we saw in the report out this morning in the household employment data. But again, having an impact here on the markets this morning, Miles, when we digest this data along with the jobs numbers that we got out at 8:30.
Yeah, I mean, services sector, about 70% of GDP. ISM manufacturing, another number that's, covered quite closely, but that manufacturing about 15% of GDP. Government is the balance for those keeping score at home. And I think it's always interesting to look at the commentary within the ISM reports and looking at the services data that we got out this morning. First comment right at the top, pricing has become more favorable in increments. So I think that's something that if you are the Fed, if you're Jay Powell, you're happy to hear. You want to hear that pricing continues to rationalize. Now, it's always kind of a mix, though. Then we still have labor is constrained. You mentioned the employment sub-index falling into contraction territory for the first time, and I think, what do you say, almost 3 years? Yeah. But it's on a constraint of labor, which is back to the tight labor market theme, which is not really what Jay Powell wants to see. It is notable, though, and Rachel Sherman calling this out in our Slack channel, that this moved Fed funds futures, right? This maybe takes off the heat, moves us back into, March cut is now a more than 50% opportunity, basically at 50% after the jobs report, back towards a 2/3 likelihood as we head towards that March Fed meeting. So interesting to see how, let's call it how trigger happy the market remains around pricing Fed moves 12 weeks from now on the 4th trading day of the year. Still a little antsy, I guess would be the right way to say it.
Extremely antsy. They're looking for any sort of news that's going to validate what they want to hear, and clearly what they are starting to price into the market, the expectation for 6 rate cuts before the end of the year. So any indication that could potentially back up some of that optimism, at least looking out into the rest of the year. They're using it as a buying opportunity. We're seeing that reflected in some of the moves today.
It's too small. I can't see the bug on the screen. I see all three. I see all
green
three
across
green.
the
I don't know
board there,
how
Miles.
much. I'll work on. I just got
Just
my
over
eyes.
100 points.
I just got my eyes
116.
checked, and they
Looks
said
like
they
we're
were
going to have
fine.
to update that prescription.
Small screen. Okay. All right. Let's switch gears. Talk a little bit about Nike stock. Shares ending 2023 in the red, down about 10%. This coming, of course, during a year when the S&P 500 was up over 20%. At the end of 2023, late December, Nike offered a downbeat sales outlook, but it did lay out a plan to cut $2 billion in costs. And our next guest still sees a lot of reasons to be bullish on the stock as we head into 2024, despite slashing their price target on the stock. Pearl Didania is an analyst over at RBC Capital, luxury goods analyst, joining us now to discuss this. So, Pearl, something that stood out in your note is the thought of a product innovation cycle similar to what Nike saw in 2017. So maybe we can go back to what the business did, almost 7 years ago now around its product mix and how you see them trying to replicate some of that success as we get into 2024.
Sure. Thank you, Miles. Right, exactly that. So the new information we learned at the first half results print towards the end of December was management articulating a change in their approach and the fact that they plan to transition the product range. I think this is across price points and across categories, but predominantly, I think, focused on footwear. And that, with the benefit of, leaning back into history, reminds us of the 2017-2018 transition that the previous management team undertook, whereby they effectively they pulled out a lot of the best-selling franchises from the market, and over the course of subsequent 2 or 3 quarters, then introduced new products, new innovation, and different-looking silhouettes in different fabrics, which revitalized, I think, the overall range, and in some ways was the starting point for a new product cycle, which actually benefited them for the subsequent 4 or 5 years after that. Our view more broadly is that the product and brand cycle in sporting goods tends to last anywhere between 2 and 5 years. And really, Nike's coming off a kind of 4 to 5 year run now. Worth also just mentioning that the competitive environment is arguably intensifying. Adidas, its nearest and largest competitor, has probably been a little bit weak in that last 4 or 5 year period, but under new management and with some products which are gaining traction amongst consumers, is arguably going to be a bit stronger in 24. So we believe Nike is just reacting to the phase in the cycle that it finds itself in.
And, Pearl, I want to dig down a little bit on the product itself for Nike. Like, are there specific lines that, as you look back at the last 4 or 5 years, I mean, as a consumer, I think of the Blazer line. It's like, I don't know, they have a whole tab now on the site just for Blazers, right? And it used to be, I think they had a mid-top and a low-top. And are there specific, products that you are thinking about they can pull the lever on in a similar way? Because, I think some consumers might be surprised at how much, the revitalization of Pegasus, for instance, could actually drive business results. It feels like it's just a fashion discussion, but how that plays as an analyst to you into the financial model.
It's a fair point. So most product lines, the franchises, typically exhibit a fairly normal life cycle curve, if you like, which everybody will understand well. Over the last few years, products like the Air Force One have been consistent bestsellers. And over the past few decades, I think it's fair to say that Nike arguably has one of the best approaches towards product lifecycle management. And after a sort of fairly strong run over the last few years, it's only natural for them to want to dial down the volumes that they supply into the market. But that does require a period of transition because the best sellers that are driving the revenues today need to be replaced by something new, which isn't necessarily well understood or driving significant volumes today, but with a view to driving growth in the future. So it's a fine balancing act, but really we're talking about the performance running side of things. When you mentioned the Pegasus, the 41 is due to be launched in April, I believe it is. Their intention, we believe, is to not allow the Pegasus 40 to be discounted too heavily in the marketplace. And to do that, they need to ensure that there isn't excess product out there in time for the launch of the 41. And then I already alluded to some of their lifestyle products. So the Air Force One, for example, the Air Vapor Max, some of the Jordan lines, I think need to be refreshed as well. So I think this will be probably a year of transition. In the 2017-2018 example, it certainly took 3 to 4 quarters, I believe, for that transition to really take hold. The intervening period can be, I guess, volatile to an extent, and there is a little bit of execution risk that's associated with that. And arguably and naturally, given where the consumer demand environment is, given where we are in terms of the broader inventory cycle for the industry, that does create some headwinds perhaps in the first half of this calendar year.
Paul, how are you factoring in some of the weakness that we've seen overseas, especially in China? How is that factored in then to your outlook? And in terms of that turnaround story or waiting to see a bigger rebound, how long do you see that, or I guess how far has that been pushed out for that to turn around?
China's a whole different topic. It's a very important one. China's something like 35 or 40% of revenues, if I remember correctly. They did flag on the second quarter earnings call that they're seeing a softer demand environment in their DTC channels from a traffic perspective globally, but they specifically called out China and the EMEA regions. That's not to say the other regions are not immune to that either. However, when you look at estimates for the second half of fiscal 24, but also going into next year, China will arguably be still one of the fastest growing regions. So actually, in terms of growth contribution, China is still very important. What Nike's done better than peers is 2 things. Number one, it's been able to deliver stronger revenue growth than its peers through the COVID period because it has a much better DTC business driven by its apps and a digital platform. But number 2, and perhaps as importantly, it's managed to maintain a profitability profile in China, which has not collapsed like it has for some of the other peers. And so from that perspective, arguably Nike's business in China is a better quality one. It, out of the Western sporting goods brands, we would argue is best positioned. And there are some changes taking place in the Chinese market as it relates to the competition between international brands such as Nike, Adidas, and so on, and the local brands such as Li-Ning and Anta, who through the COVID period saw significant growth. You may have seen the recent share price moves in stocks like Li-Ning, which are down 70%. There is a bit of a, how do I explain it? Arguably, those brands, the local brands, took too much pricing. They tried to elevate from their core competency. And now with a less favorable macro and consumer backdrop, their positioning looks stretched. And at the same time, the Western brands with clean inventories, with, I guess, a revitalized business model and strategy are taking back some of that momentum and share at the expense of the local players. So actually, we're fairly encouraged and positive on the China outlook for over the next 12 to 24 months.
All right, Paul Dadania, Markets Executive Director and Luxury Goods Analyst with RBC. Thanks so much for joining us here.
Thank you.
Keep it right here on Yahoo Finance. Much more of your market action ahead. Again, all 3 major averages trading to the upside for today. You're looking at the Dow hovering just around up about 100 points here an hour into the trading day. We'll be right back. Some weak data on the housing market, mortgage demand dropping over the holidays. This is according to the latest data out from Mortgage Bankers Association. Now, that's even as mortgage rates continuing to fall through the month of December. We did see, though, rates level off just a bit because just last week, rates ticking just a bit higher. Now, our next guest being a bit more optimistic about the real estate market this year, but encouraged about some of the buying activity that we could see. For more on that, we want to bring in Daryl Fairweather, chief economist with Redfin. Daryl, it's great to have you here. So let's talk about what we're expecting from the Fed, potential rate cuts this year, what exactly that then means for potential home buyers out there. How big of a driver do you see that being for the housing market in 2024?
The recent data from the economy shows that the economy is starting to normalize, which is why the Fed can pull back a bit. And this is great news for the housing market. The recent decline in rates has already encouraged more buyers to come back, and sellers are coming back too. So with more supply and more demand, it just looks like it's going to be a healthier year for the housing market.
So talk to us a little bit more about a healthier year. Than what more specifically should we be expecting?
There will be more buyers and more new listings. It's a little bit too early to say exactly how strong demand or supply will be, but I think we're going to see more sales this year than last year. And it's a bit uncertain if prices are going to go up or down. We're forecasting that they go down just a little bit, but that could change if demand comes back stronger than supply does.
So when we talk about affordability, obviously a massive issue here. We are seeing maybe some improvement when you take into account that mortgage rates, the 30-year mortgage rate off the highs that we saw not too long ago. How do you see that story playing out, given the fact that we would likely see a supply shortage if we do see any improvement on pricing?
The recent decline in rates is improving affordability already, but I think the window for which affordability is going to improve is going to be a short window, potentially only this year, because once buyers come back to the market, they're going to start competing, and that's going to drive up prices unless we see a substantial increase in supply to match that demand. And there's really no place for that increase in supply to come from because we're not seeing as much new construction as we did these past couple of years.
When it comes to that new construction, clearly a lot of potential home buyers, especially new home buyers, really not given another option, given the fact that existing homes simply are not on the market. How big of a player do you see that being in the housing market this year and the ability maybe to alleviate some of the pain that we're seeing for inventory levels?
I think new construction is going to play as big of a role this year as it did last year. We're going to see more existing homeowners decide that now is a good time to move. People who had been previously putting it off because they didn't want to trade their 3% interest rate for a 7% one, some of those people just can't wait any longer. And also the decline in rates is making that decision not so difficult. And new construction has already slowed down. So I think it's going to be more driven by existing stock of housing than new construction this year.
All right, Daryl Fairweather, great to have you here, Redfin's chief economist. Thanks. Keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back. Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom.
AI boom.
Increasingly powerful AI models.
AI.
AI.
Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
Citi out with a call on Starbucks here this morning, opening a 30-day negative call on the stock. Taking a look at shares off just about 0.1%. The stock has struggled over the past year. You're looking at losses of just about 10%. Brooke DePalma is here with the latest on that. And Brooke, what is some of the downside risk, I guess, associated with Starbucks, at least in the near term?
Yeah, well, certainly what John Towers, Citi analyst, sees here is maybe U.S. consumers are finally pushing back to those higher prices in this note out this morning. He cited a potential risk to fiscal first quarter sales results given weaker foot traffic here in the U.S. throughout the quarter, which ended on December 31st. Now, in addition to that, he also cited challenging weather comparisons and that new Bring Your Own Cup platform. Well, he has lots of questions about it. He said that basically this promotion that allows consumers rather, to bring their own personal cup when ordering in-store, in drive-thru, or via their mobile app, that is intended to save customers 10 cents per order, and it's part of Starbucks' long-term goal to reduce waste by 50% by 2030. But Tower questioning here how exactly this could impact operations. He said that they find it hard to see how adoption of this additional exchange, what they're calling using a vessel for customers to put their cup in and then exchange it with the barista, might slow down drive-thru, disrupt flow, require yet another chunk of investment and labor, and Shauna, ultimately creating some confusion here about what exactly quantifies the right cup size, what exactly a personal mug might mean in terms of a venti, and what constitutes a clean cup. So many questions about this new BYOC, they're calling it, Bring Your Own Cup platform.
I like the initiative, but certainly there are a lot of questions not only for consumers but also for investors out there, just in terms of the impact that that's going to have operationally speaking for the baristas that are there. So, Brooke, when you zoom out just a little bit, obviously the macro concerns, clearly a headwind here for Starbucks, at least over the next several months. They're also facing more pressure from union officials, from activists surrounding their business practices. Where does that stand and the impact that we could see then on Starbucks down the line?
Yeah, in 2023, it was sort of like mum's the word. We didn't really hear too much about unions. And then at the end, it really came to more of a robust chat. Starbucks did say, they did propose that bargaining will resume this month with a set of store representatives. Now, it has been 2 years since Starbucks, that first store in Buffalo, voted to unionize. The company, though, facing ongoing pressure. Last month, report results of Starbucks labor practices prompted by shareholders found no evidence of anti-union playbook, but did criticize the company for falling short of commitments and made to respect union activity. And it really is a he said, she said, a Starbucks Workers United member telling Yahoo Finance last month in a statement that they claim that the company continues to illegally retaliate against workers who are organizing and is challenging ongoing elections. Of course, April, or rather end of March, marks 1 year since the new CEO, Lakshman Narasimhan, came into the role. And so really he's looking for a direct relationship with his employees, and he really is doubling down on reinvigorating the partner culture. So lots happening here as we make way into 2024.
Yeah, certainly, and shareholders, I would guess, pretty upset just about the performance that we've seen at least over the last year. So we'll see if some of these changes pay off here in the long term. Brooks, thanks. Let's talk movies here for the year. The global box office hitting nearly $34 billion in 2023. That's according to the latest numbers from Gower Street Analytics. That's up 31% from 2022, but still lags pre-pandemic levels. Estimates are now out for 2024, and we're expecting a drop this year from last year's levels, due in part to the Hollywood strikes earlier this year. With more on that, we want to bring in Chris Fenton. Chris is a movie producer and author of the Hollywood business book, Feeding the Dragon. Chris, it's great to have you. So let's first start big picture in terms of what you are expecting at the box office this year. Are we going to see a bit of a dip compared to last year's numbers?
Yeah, well, what's interesting is the international box office is crawling back to pre-pandemic levels, like you said, but the domestic box office is really hurting And if you look at the actual estimate for next year at $8 billion, and even this year, which hit $9 billion, you're back to 2001, 2002 levels for U.S. box office. So it's definitely something concerning.
When it comes to the fact that there aren't many maybe potential blockbusters here for the year, those, though, that you think could do potentially well, what are they, and why do you think it's going to resonate a bit better with audience?
Well, I'm particularly excited about the sequel to Dune. That was a fantastic first film, and there's a lot of great expectations around that. There's also a Lion King sequel coming up. There's some particularly interesting original films coming up, like, for instance, Civil War and Argylle from Matthew Vaughn, who brought the Kick-Ass series. And then on top of it, you do have stalwarts like the Deadpool series that's coming out again next year, too. So there's a lot of expectation around some of these franchises that are popping up in 2024, but there's just simply not enough of them to keep the theaters full.
And when it comes to the outlook, and specifically the outlook here for theaters, AMC is one of the tickers that tends to trend a lot here at Yahoo Finance, given the fact that so many retail investors continue to be interested in the names. But AMC hitting all-time lows this week. What do you think the future holds for a company like AMC, given the fact that a lot of these theater chains are struggling to get people back into the theater?
Yeah, well, I particularly love this conversation because when you look at what the Hollywood studios make, it's super premium content. That's what I refer to it as. And there's only 100 units of that made a year by the major studios and the big streamers. So that's 10,000 minutes of content. And then if you look at the amount of content made in a single year in today's world, there's more content made in 365 days than there are in the whole previous history of human mankind. So if you got 10,000 minutes of that Hermes Kelly bag, that luxury brand, it's going to work. The question is, where are people going to consume that super premium content? And if I had to guess, I unfortunately think AMC will probably go bankrupt this year, but you will see luxury branded bricks and mortar exhibition like IMAX really pop to the next level, because that is that luxury brand, and it coincides with the luxury brand of what the Hollywood studios are making as far as content is concerned.
Well, Chris, and talking a little bit more about that and some of the changes, the disruption that we have seen play out across the media landscape, given the rise in streaming, any idea, or I guess, what's your insight in how studios are thinking about their releases and how dependent they are on these theatrical releases versus some of the traction that they'll gain when they release, or if they do release, on some of these streaming platforms?
Well, the fantastic thing about the streaming apparatus is that it does allow an option for a studio to release what we would call in Hollywood a dog of a film, right? A film that typically, if you release it theatrically, would cost a lot of money in marketing and distribution costs, and it simply wouldn't recoup any of its equity investment because it just isn't a great movie. But the fact is, these films have huge scale, they have big concepts, they have IP, and the streamers really like those movies because they know that they can draw some of their subscribers to them. So the fact is, in the old days, you might have a zero return on particularly bad movies that come out of the pipeline and just simply aren't all that good. But a streamer might see that as something that's worth paying that equity for, licensing it for 10 years and finding a really strong audience for it. So the studios have this great sort of exit ramp that didn't exist, say, 10 years ago. And that is a huge plus, especially with the fact that the movie studios now are looking to actually license their content again, because we did go through a few-year period where they wanted to fully own it and just put it up on their own platforms.
And Chris, we're also getting numbers out from China just in terms of what they're seeing at their box offices, soaring 83%, reaching $7.7 billion in 2023. We got to put that in context, though, obviously, given the pandemic and what those comparison numbers are looking like. But what's your sense just in terms of the reliance that we should have right now on China in terms of what they're seeing, the traction they're seeing at the box office, and how that compares to the activity here in the U.S.?
Well, look, the golden goose of the China market has disappeared for Hollywood. In fact, if you add up the box office gross of all the Hollywood movies this past year, they made less than the Avengers Endgame did in 2019. So it's a real problem. But if I were betting on what kind of product and service out of the United States of America would work in that market, it's things that combine culture and commerce together. So I'm willing to bet, like you had an analyst talking about Nike and China, Nike is going to continue to work there. Yes, they're going to work through certain issues that they have, but that cultural fabric that brings the two countries together is super important for a brand like that. And it's the same thing with the Hollywood content. It bridges two superpowers that don't necessarily get along very well, and it also prevents conflict if it works. So I have high hopes that we're going to bounce back, not back to the glory days, but we will have a viable market there, and it will help Hollywood make their P&Ls work a little bit better.
All right, Chris Fenton, always great to have you here at Yahoo Finance. Thanks so much for joining us here this morning. Have a good weekend. All right, keep right here on Yahoo Finance. We'll have much more on the other side. Again, taking a look at some of the market action that we're seeing following the stronger than expected headline number from the jobs report. You're looking at the Dow up just about 140 points, the S&P up about 0.6%. We'll be right back. Let's take a look at today's trading action. About an hour and a half into the trading day, investors now taking some time to digest what has been mixed reports here on the U.S. economy out this morning. You're looking at the Dow now up 138 points. Taking a look at that jobs report that was out at 8:30, showing that the U.S. economy added 216,000 jobs in the month of December. Unemployment holding steady at 3.7%, below what was expected. And traders are squaring that with the ISM services data that we got out this morning. So we've seen a bit of movement in what traders are pricing in for the Fed's first rate cut, which is really having an impact on the markets here this morning. Rate cut odds now back around that 70% level that we were looking at not too long ago for March. Now that's up from around 50% of what we saw following the jobs report this morning. We're also seeing some of the action in the bond market here with the 10-year yield now back below that 4% level. We'll keep it right here on Yahoo Finance. Rochelle Akufo has you for the next hour. We'll see you on Monday. Have a great weekend.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. A better than expected jobs report. The U.S. economy adding 216,000 jobs in the month of December. That's significantly higher than the street's estimate of 175,000. And Microsoft looks to take back its market cap crown. The tech giant is closing in on Apple for the title of most valuable U.S. company. Plus, Costco sees sales rise in December, boosted by strong demand in e-commerce. We'll break down that report later on in the show. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at green across the board, although it has been a volatile morning on that hot jobs data, really making markets take a pause there, wondering if those rate cuts that they were so enthusiastic about pricing in are going to end up paying off. But at least for now, the Dow currently up about 117 points, or about 1/3%. The S&P 500, they're also seeing gains, up about 2/3%, or about 30 points. We're seeing communication services leading the way sector-wise. Tech-heavy NASDAQ there, Still in the green as well, up about 0.8% on the day, up about 113 points. Well, let's see how all that data stew affected the Treasury markets as well. Looking at the shortest term yield, pulling back about 1.25% there. The 10-year, it had ticked up at about 4 and dialing back now, currently down about 0.7%. The 30-year also down, but ever so slightly, but sitting at 4.13. Well, the December jobs report coming in hot, pointing to a stronger than expected labour market. The unemployment rate holding steady instead of rising as expected, and year-over-year wage growth holding steady as well. Our next guest says while the labour market is not too hot and not too cold, we still aren't sure if it's just right yet for the Fed. Joining me now is Chris Rupke, Forward Bonds chief economist. Thank you for joining me this morning. So, as we dig into what we've seen here with these jobs numbers, a few things to sort of factor in. I mean, we had the UAW auto workers coming back into the picture here, some seasonality at play. But overall, what's your big takeaway on this jobs number?
Well, it was clearly stronger than expected. If you take out the auto workers strike effects from October and November, December, 216,000. That's a pretty solid number. In the old days, we used to think anything about the economy creating 200,000 or more payroll jobs per month, that it was, clear sailing and calm seas ahead and stronger growth for the economy. So nothing looks really wrong with the labor markets going into the end of the year. In fact, it looks quite positive.
But then as you look at the revisions that we saw for October and November as well, what should we be honing in on as we look at really the what this means for the Fed and how they should be viewing this, as they don't want to just sort of go by 1 month, especially with these revisions in mind?
Well, the revisions aren't too bad. I mean, it's always quite volatile. They revised down the numbers from October and November, 71,000, I think. That doesn't worry me. I'm looking a little more at wages because a lot of times the markets focus on average hourly earnings, which is the proxy for inflation, if you will, in this report. And we have seen wages going up 0.4%, both in November and now again in December in today's data. So 0.4% is pretty fast, but we just had Fed Chair Powell saying that he doesn't believe necessarily that higher wages stokes the fires of inflation going forward. So I would kind of write off the 0.4% increase in wages, because don't forget, core PCE inflation in October and November barely changed. It was 0.1% each month. So inflation seems to be coming down anyway.
And another number that we're, of course, watching is the labor force participation. Did see that declining. Is that giving us any signals? When you're looking at the different data points, you have an inverted yield curve still, and you look at what we're seeing with this very resilient job market, and people who feel better about having a job also tend to spend more, which feeds into the consumer as well. How do you see that playing out then in the months going forward?
Well, I mean, we've had some gyrations during the pandemic, of course, where the participation rate went down and then is climbing back up. But, over time, with the baby boom generation who are now this year 60 to 78 years old, as a baby boom continues to move forward through retirement, participation rate's probably going to come back down. It went up during the 80s when the baby boom was entering the labor force, especially women, the first time in the 70s and 80s, and now it's on a long-term decline. So I don't make too much of that. They did do a revision to the unemployment rate, which they do every year. And we had seen that unemployment rate was as high as 3.9% in October, but the revisions came through and they knocked that down. It's only 3.8% now. So what we're looking for is unemployment rate was 3.4% back in April. It rose as high as now 3.8% in October. That's not, it's about 550,000 people out of work, which, the markets and the Fed seems to forget. There are people out of work, but the joblessness out there isn't high enough to signal a recession at this point.
And as people have been wondering about, recession concerns here, what does this latest jobs data signal about the enthusiasm that markets had for the potential for a rate cut in March, does that take that off the table?
Well, we only get 2 more. Well, no, I guess we January, February, March. Sorry, I'm counting. We get 3 more jobs reports to go before that. I think March is a little early. Don't forget the Federal Reserve is a slow, deliberative, rule-making body, decision-making body, and I don't think they're going to be forced into it that quickly, unless there's something like higher unemployment or falling payroll jobs. You cannot have a recession without falling payroll jobs, and we simply don't have it. If we look at the yield curve, part of the reason the market's on guard and always sees recession around every corner is the yield curve inverted way back in November 2022, and that said a recession was coming from July last year up through March of 2024. So we got 3 more months before we have to throw away another leading indicator of recession, that is the inverted yield curve. 3 more months to go, and we're still looking for recession.
Indeed. So then do you think it's too early to say that the Fed can stick the soft landing here?
Well, it's looking pretty good. If we continue to get core monthly increases in PCE inflation over the next 4 or 5 months, the Fed and the markets really have the data at their back, given what happened a year ago when there was higher inflation. So at some point before the June Fed meeting, we're probably going to see core PCE inflation with a 2% handle. And that means to me that the Fed's probably going to want to cut rates for the first time in 2024 for this interest rate cycle in June. June would be my bet. March is a little too quick.
Well, certainly we'll see. I appreciate you taking the time to join me this morning. Chris Rupke, Forward Bonds Chief Economist. Thank you so much. Have a great weekend.
Thank you.
Well, the labour market under President Biden remains tight. The December jobs report coming in stronger than expected, adding 216,000 jobs in the month, bringing the number of jobs added in 2023 to 2.7 million. Here with what this means for Biden in 2024 is Yahoo Finance's own Rick Newman. Hey, Rick.
Hey, Rochelle. I don't know that it means all that much for Biden. I mean, he has been trying to persuade Americans for many months now that the economy is solid and getting better. The data supports that. I mean, you just mentioned really strong job growth. I mean, we have had job growth literally every month that Biden has been president. That's 36 months in a row. Of course, inflation is the problem. And there's been an interesting pivot in the Biden campaign recently. They are signaling that President Biden is going to start the 2024 campaign season by emphasizing that he is the guy who can best protect democracy, not the economy. And that is a bit of a puzzling pivot because the old adage is still true. It's the economy, stupid. This is the number one thing that people vote on, whether they feel better off under the current president or they think they'd be better off under somebody new. And Biden is kind of like throwing his hands up in the air and saying, I give up, trying to campaign on the economy because it hasn't been working. His overall approval rating is pretty terrible. It's around 40% or even lower. His marks on handling of the economy are even a bit lower than his overall approval rating. And perhaps most worrisome for Biden and his supporters is that polls consistently show that people think Donald Trump would do a better job handling the economy than President Biden. So Biden needs something else to run against Donald Trump, his presumptive man he's going to run against in 2024 in the general election. I just don't know if voters are going to say, oh, democracy more important than the price of groceries or gasoline. But we're going to find out. Very interesting campaign coming up.
Indeed. And of course, January 6th tomorrow, we know that's going to be, of course, a hot topic here as people really are still divided down party lines, even if the economy is doing well, still not hitting home for people. So what do you think is going to be the message here as this campaign season then kicks off for President Biden and Vice President Harris?
Well, Biden for sure is going to try to take advantage of all of Trump's legal problems. And the polls suggest there's some hope there for Biden. There are some Trump supporters who say, yes, they want to vote for President Trump in the 2024 presidential election, but that could change if he is actually convicted of a crime. Now, we don't know that any of these four major criminal trials will actually get to the point where Trump there's actually a trial that results in an outcome. Trump is trying to delay many of those. Some of them are in appeals courts, including the Supreme Court. But that could change something, and that does get to Biden saying, "I'm the man to protect democracy." And if he can say, "Look at Donald Trump, he's now been convicted of something related to obstruction of justice," or there is another trial looking at his role in the January 6th riots, that could be it. But I think what Biden really is waiting for is just enough improvement in the economy. And that mostly means inflation coming down even lower and perhaps even declining prices that make people feel like they're regaining some of the ground they lost to inflation. Grocery prices are a big one for people. And even though the rate of inflation is now back down to the normal range, all the price increases of the last 2 years are still there. And people know it. People know that something costs $1 more than it used to, and they need to buy that every week, and they're not happy about that. So Biden still needs an improving economy to be able to persuade voters they should give him another 4 years. I just don't know if it's going to improve fast enough to change people's minds.
It's true, November, a long way away. So depending on how prices are looking right before election season, that'll certainly be a game changer there. Yep. Appreciate you, as always, our very own Rick Newman.
Yeah, Rochelle.
All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. All three major indexes bouncing back this morning as investors digest strong labor market data that will play into expectations for interest rate cuts. While we have seen pressure on US stocks in the first week of 2024, our next guest says there's still reasons to be bullish. Let's bring him in. Ryan Dietrich, Carson Group Chief Market Strategist. Good to have you on the show here. So why so bullish after the week that was?
Yeah, we might have the first green day of the year today, so there's something to celebrate a little bit. But listen, I know a lot of people talked about the end of the year rally that was really strong, but then we didn't gain during the Santa Claus rally. Like the last 5 days of the year and the first 2 days of this year usually are higher, and they weren't higher this time. And there's a ton of ways we can look at this. I think I'll put it like this: we're in the midst of a 9-week win streak on the S&P 500. We think stocks were simply due for a well-deserved break. It's not like we're selling off massively here. I know tech's underperformed a little bit to kick this year off because of those Apple downgrades. We can get into some of the more of the reasons. I'll put it this way, though. A year ago, we didn't see a recession. We still do not see a recession. When you don't have a recession with likely record earnings, with productivity coming back, look at today's jobs number, we get into all this stuff, but it just still makes sense to us that the path of least resistance, at least for stocks, is still higher.
So walk us through that base case. Obviously, the Mag 7 really led the charge. A lot of people said, it was AI fueled. Coming into 2024, investors really want to see that where the rubber meets the road in terms of use cases there. But then, when you look at how the Mag 7 have performed so far, some broadening out of the rally, but are you as convinced at the moment, given where valuations are?
Yeah, we're more neutral, Mag 7 technology in general. We were more neutral all of last year. Trust me, I wish we were more overweight, the large cap tech names, but we just still see a little higher valuations. One of our big themes, though, really started in the middle of last year, was broadening out. We liked small and mid caps the second half of last year. Now, believe me, for about 3 or 4 months, that wasn't so fun. Now that the Fed is clearly saying we're probably done, the market's looking at interest rate or looking at cuts coming, we think small caps and mid caps are going to do really well, that broadening out theme. And here's something to think about. The Russell 2, right? The Russell 2 just had one of its largest 2-month gains ever, like over 20% the last 2 months last year. What does that mean? We took a look at the 10 best 2-month periods ever. Keep this really simple. 1 year later, the Russell 2, when you have a month, 2 months like we just did, has been higher 9 out of 10 times, up 27% on average a year later. Put a bow on this. That strength we saw to end last year to us is likely the sign that this broadening out, this strength is real, and small and mid caps and probably cyclicals as well will do better, taking the baton from the large cap tech, which obviously did so well last year.
So Ryan, what's going to be the catalyst then that really broadens out this rally?
Yeah, well, I think it's happening right now. And it is the realization that inflation is coming back down, that the Fed is likely done. Also, so we know those things. Those things are out there. One that maybe is not talked about as much is productivity. The last time our country had really strong productivity was in the mid-90s. And we've seen 2 quarters in a row of good productivity. What does that mean? We hired, 5 million people 2 years ago, like another 2.5 to 3 million people last year. People aren't jumping around from their jobs like they once were. So they're kind of happy where they are. We think our country is about to have a major surge in productivity, not even to mention, the AI and some of those other benefits that could be there. What does that mean? Well, in the mid-90s, you had higher productivity. Greenspan saw it. He cut. There's a cap on inflation. Oh, and by the way, wages stayed high. I mean, that's a pretty perfect scenario. If we can see that again, I'll be very clear. We think there's a chance, though, that can be the case. So productivity is a big key to us this year. If it stays stronger than people think, there could be a really good scenario where inflation is not a worry, wages are higher, and the Fed can cut. So that's how we see things playing out probably.
So then in this ideal situation, when you have everything potentially rallying here, what are you steering clear of? What are some of the risks that you're keeping an eye on?
Yeah, absolutely. I mean, again, we're overweight the cyclical names, right? That I talked about, industrials, financials, more even weight technology. What we're underweight, at least, is some of the defensive areas. I mean, honestly, you want to see utilities lagging. You want to see staples lagging. If that changes, that could be the market's message of some type of a warning. So we're underweight there. Also fixed income. I mean, we came into last year very, very short duration bonds because we thought interest rates would go higher. We expected a better economy actually last year. So we thought that might hurt bonds a little bit. Now there's some opportunity clearly with fixed income now, but we're still underweight bonds right here. And we actually have a little bit of a sliver of gold in some of our tactical models. By no means are we like end of worlders or, gold bugs. But hey, we think gold could actually do pretty well this year as well. So that's kind of how we are. But we would not avoid, that's a strong way to put it, be underweight again, fixed income and some of the more defensive areas.
And Ryan, you didn't see recession last year. You're not predicting it this year either. What is it that's giving you so much confidence? What are some of the data points that you'll be looking for between now and when perhaps you see the Fed starting to pivot?
Yeah, great question there. I mean, just earnings. I mean, listen, let's see what happens. Earnings season is going to start soon. We're looking at probably 12% S&P 500 earnings growth this year. We really think it could be a little bit stronger as the global economy comes back. Look what happened last year, right? China clearly was kind of a headwind for the global economy. Now, that we're not warm and fuzzy China, I want to be very clear. But again, the U.S. is going to lead, but there are some parts that are coming back. Also, hey, the consumer was the all-star last year. We're not seeing any breaks in the consumer, any cracks in the consumer. But manufacturing and housing, we're kind of headwinds last year. We're starting to see manufacturing show signs of improvement. Look what happened with interest rates, some of the housing data. So again, those are kind of some of the things that we see that suggest to us, led by a strong consumer, that the odds of a recession are just still quite slim in 2024 in our view.
So right, so just to clarify, the recession, will it be the consumer that makes or breaks it, or will it be something else?
Yeah, it'll probably be the consumer. That's a great point. I mean, the consumer makes up, 70% of GDP. So I think, it probably would be the consumer when that eventually takes place. But I'll tell you, look at real wages, right? Everyone knows, just the discussions you had before I came on. Inflation. We get it. I mean, it's still out there, but inflation has come back an awfully lot, especially when you take out shelter. Nonetheless, when you look at real wages and real incomes and real net wealth, I mean, it is what it is. Those things are near all-time highs. So people don't like paying more for things, but in a lot of cases, people are worth a lot more and they're probably making a lot more. So that's kind of one of the big drivers that is not a problem for the consumer as of now, at least.
And that's certainly important context when we think of, especially when we look at things like consumer sentiment. So appreciate you joining us. Ryan Dietrich, Carson Group Chief Market Strategist. Always good to have you on. Have a great weekend.
Thank you. Happy New Year's. Thank you.
Thank you. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom. AI boom.
Increasingly powerful AI models.
AI.
Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
Maersk is warning customers of major disruptions after diverting all vessels from the Red Sea for the foreseeable future. Just last weekend, a vessel from the Denmark-based shipping company was attacked. It then rerouted all ships around Africa. So what does this mean for shipping stocks? Yahoo Finance's very own Ines Ferrer here to break it all down for us. Hey, Ines.
Hey, Rochelle. And shipping stocks have been on the uptrend since mid-December when we started to hear about these attacks on vessels and when shipping companies started to temporarily divert their ships or temporarily not use the Red Sea. This is because of Houthi rebel attacks against vessels. And we just want to throw up a map for you so you can see what we're talking about when we're talking about the Red Sea. It's the body of water that connects to the Suez Canal. That's the shortest waterway between Asia and Europe. And shipping cargo companies use this body of water to transport everything from wheat to crude. So Maersk, as you were just mentioning, has said that it will, for the foreseeable future until further notice, stop using that waterway. And this is significant. There are analysts, Goldman Sachs this week and also Bank of America upgraded Maersk to neutral from sell, increasing their price target on the stock, because what they're saying is that you've got now about 70 to 80% of vessels that are rerouting as of mid-December. It's making their journey 30% longer, and the freight costs are going through the roof. In fact, in Northern Europe, from Asia to Northern Europe, those costs have gone up by 173%. Of course, you also have insurance costs that have gone up too. But for the bottom line for these shipping companies, well, higher freight costs is beneficial to their bottom line, and limited capacity, of course, is sending those freight costs higher.
Indeed, that's a significantly longer route if they're not able to pass through the Red Sea. Appreciate you, as always, Yahoo Finance's own Ines Ferrer. Thanks so much. Well, Microsoft is about $100 billion away from overtaking Apple as the most valuable company in the US. This comes after two analysts downgraded Apple this week. Yahoo Finance's own Jared Blickery is here to break it down for us. The battle of the tech giants, Jared.
Yes, and thank you for the introduction there. Here's a market cap over the last 5 years of these two giant companies. And by the way, they're very different companies, but we can compare them. Apple is in purple here. It's currently on top. And here's its $3 trillion plus peak. And here's Microsoft in cyan, just a little bit lower right now. But you can see Microsoft at times over the last 5 years has led Apple for brief periods of time, including coming out of those pandemic lows. But really, you go back 10, 20, 30, 40 years, and you can really see the difference between those two companies. I'm going to compare now the stock prices of these two companies over the last 10 years. You can see Apple's up 842%. Microsoft is up 904%. So kind of neck and neck right there, with Microsoft a slight edge. You look at the 20-year chart, what happened? Apple's up 45,000%, Microsoft up 1,200%. I think a lot of investors would take that, but essentially if you had to buy 2008 to 2010 to reach any kind of comparable number with Apple, and if you got in between 2000 and 2008, that was dead money. That was a losing trade. And that's because in the wake of the tech bubble and also the antitrust suit that Microsoft was facing 20 years ago, it just became dead money for about a decade. Let me now show you the story in terms of sales growth. This is Apple sales growth going back into the late 90s. This is when Steve Jobs took over. And let's not forget, Apple was left for dead, almost went bankrupt. How about that? But this incredible years, these years of sales growth here, a lot of them topping 75%. That's the iPod, and then that's the iPhone. And you can see things have trailed off. The services side of the equation has gotten a lot of play here, but it doesn't always live up to expectations. Right now, 4 quarters of declining revenue growth. That is a negative situation for Apple. Expectations are for that to be broken, but we'll have to see how this plays out in earnings season. Give it another month.
Looking forward to that. Our very own Jared Blickery. Thank you so much. Well, taking a look at shares of Costco this morning on news that net sales rose nearly 10% year over year in December, pushing past $26 billion US. The company says that it was helped significantly by its e-commerce business. You see there the stock price being rewarded this morning. So let's bring in Yahoo Finance's Brooke De Palma to give us those details. Hey, Brooke.
Good morning, Rochelle. Well, Costco, the warehouse, certainly continuing to benefit, continuing to see a strong foot traffic growth in the month of December. If you take a closer look at those numbers here in the U.S., including the gas and foreign currency, we saw high single-digit growth of 7.3% here in the U.S. When it comes to same-store sales growth, and in Canada, we saw low, mid-single digits there of 12.8%. Now, December did have one additional selling day due to the timing of New Year's Day. That benefited total and comparable sales by approximately 3%. But here are some drivers that drove the month of December same-store sales growth. Food and miscellaneous goods, well, they got a boost there. They were positive high single digits as consumers continue to bulk up on their grocery. We also saw customers flock to fresh foods. They were up high single digits, boosted by bakery as well as produce. And we see consumers returning a bit here to discretionary goods. We saw non-foods in the positive high single digits, boosted by things like gift cards, jewelry, as well as tires. But some weak spots there. We did see toys, seasonal sporting goods, as well as office supplies perform weaker during the month of December at the wholesale retailer. But that e-commerce play, Costco really looking to double down and compete against big players like Walmart, like Target, that are certainly bulking up their marketplaces. We did see e-commerce jump 17.7% last month. And on the latest quarterly results, CFO Richard Galanti said that they saw a lot of strength last quarter when it comes to e-commerce sales. They also said that the team is right in the middle of a 2-year plan to ramp up their online presence. And that certainly seems to be working for the wholesale retail giant.
Indeed. I mean, especially when you compare it to the others. So then, Brooke, how is the street reacting from this positive news?
Yeah, well, there was a note from Bank of America out this morning, and they're citing that Costco, as well as other wholesale retailers, continue to benefit as consumers really look to cheaper prices as they're continuing to adjust their wallets for this higher inflation that's really holding fairly modestly now, really remaining flat year over year. He also noted some other factors that Costco continues to benefit from. That includes increasing average of members per club and executive memberships, a record renewal rates with more and more customers continuing to go to Costco, expanding digital opportunities that we just hit on, that e-commerce boom that the wholesale retail giant is really doubling down on. And another thing is that potential membership increase. Now, this typically happens every 5 years and 7 months. We haven't seen it just yet. We've passed that timeline. They did note that it's a little longer than usual. But CFO Richard Galanti saying yet again on the call, it's not a matter of if it'll happen, it's just a matter of when. And lots of analysts on the street certainly looking to that potential membership fee hike as a benefit for Costco.
I know we're taking a look at that. Consumers be sort of weighing the odds there of the price increases versus, what you get, the bang for your buck that you get at some of these big box stores. Exactly. Appreciate you, as always, our very own Brooke De Palma. All right, well, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance. Jefferies downgrading Palantir this morning to underperform from hold, slashing its price target to $13 from $18. The firm says the company has seen, quote, unsustainable valuation levels on the back of AI euphoria, but reiterates that long-term Palantir still has an AI technology advantage. For more on the software space, we're joined by Brent Thill, Jefferies senior analyst. Thank you for joining us, Brent. So talk about this note here and this bearish stance that we started to see that really in sort of mid-November regarding Palantir and this euphoria here. But what brought you to this decision?
Yeah, we think Palantir is a fundamentally amazing business. We're talking about the stock, and the company stock had a huge outperformance last year on the hype of AI. And I think what we're seeing is AI is a driver, but it's going to be a slower revenue materialization to the overall impact of the story, and many stories, including Microsoft and others. So we are huge fans of what's going to happen due to AI. But again, as we said, that the hype is ahead of the reality. And we think, again, the stock, given the magnitude of the outperformance last year, we simply just like other names in software like Monday.com, Microsoft. There's a handful of others that we like better. So it's a relative call. It's a call that, hey, stock had a huge move. There's no smoking agenda here in terms of something that's happening that we detected or field checks or any of that. That's not the case. The case of this is just more of a we like other names better. And this was one of the top performing names last year in the software industry.
And obviously, a lot of people were wondering when we were going to, really get to see some of these companies in terms of the timeline of when we'd really get to see this affecting actual fundamental business here. So are there any other names in this space then that have really benefited from the AI stock boom that we saw last year that perhaps could do with a little more scrutiny?
Well, the big winners in AI and software last year were Microsoft and Adobe. They have the best product lineups and the best product shipping. They also had phenomenal returns, anywhere between 50 to 80+% returns last year for the two stocks. So, I think our AI picks have done well. Clearly, some of the smaller emerging names did better. But what you do is you have the diversity of the stories at Adobe and Microsoft. It's not all about AI. In fact, we did a CIO survey in December, and that survey suggests that AI is probably, fifth or sixth on their priority list. Moving to public cloud, continued rollout of productivity applications, other things are more important than AI. So I think we have a list of names that will benefit, which again, Intuit, Microsoft, Adobe. There's a handful of great names in large cap. There's an emerging group of small cap names that are going to benefit as well. But I think what you want to be careful is, given the magnitude of the move on all the AI hype, it's typically best to kind of let that wear off and then come back to these names at a lower level. And so we're big believers, again, as they say, we're going to overestimate the near term and underestimate the long term. And I think the long term looks really good as it relates to the AI adoption. That's just going to take time. And today, when it looked as a percent of revenue, these companies, it's all single-digit percent of revenue of overall revenue streams for the majority of our companies we cover.
So then as you look within the business itself, looking at Palantir, some of the slowdown that you noted in the commercial and government businesses, is that something you expect Palantir to be able to bounce back from, or have we come to some sort of normalization here?
No, I mean, based on their rhetoric, revenue growth should accelerate, based on what they're seeing and what they're doing in their product line. I mean, we've talked about this, since they did this direct list way back when to come public, that the biggest issue, the analogy I had was Palantir felt like Tesla, right? Every time everyone saw the first Tesla, everyone's like, wow, you got to be a high-end lawyer or a doctor or, a hedge fund manager to own a Tesla, like the first Tesla. And now, interior designers and call center agents, I mean, you can drive a Model 3 or the Model Y, right? They brought Tesla to the mass market. And what I think we've seen is I think Palantir can do that. Today, it's a very heavy, customized piece of software that the Army and other big oil companies use to do really high-end work. Ferrari, uses it to to understand the performance of their cars, or one of the other racing companies. It may not be Ferrari, but when you think about, like, it's heavily customized. Can they create AI for the mass market for the 200-person manufacturing company in Des Moines, Iowa, or a healthcare company in Florida that are 20 scientists? I think that's the opportunity. And that's the big kind of target that they're shooting for. I believe that they can get there over time. I just think in the short term, it's difficult, right now to make the call that they're there, and it's gonna play out. So I'm not against the opportunity set of where they're going. I just think it's going to take time to achieve that vision, just similar to what it took Tesla to get there.
And so, Brent, with that in mind, for all the companies that did benefit from the AI boom, what will you be looking for in some of the earnings calls coming up this month?
Well, I think the number one piece is just state of business. How are things tracking? What does the environment look like in the short term? If you think about the bigger issue right now is the state of the environment. And at the end of last year, everyone felt like the economy was getting better. Rates are coming down. Are things starting to open, or are we still seeing some concern around IT budgets? So strength of the 24 pipeline, are we going to have more of a back-end loaded year? What's happening on close rates? Again, stocks that had huge moves in software and broader tech, and effectively some worry that maybe these stocks are ahead of the actual fundamentals. So we'll get a chance to hear more about that. And that's going to be kind of the number one. I think number two is the timing of AI and revenue, right? Today, all these AI stories are so minuscule in terms of impacting the revenue. When does that have an impact? And then I'd say number three, a lot of software companies haven't been adding capacity. They haven't been adding employees. They've been cutting employees. So are we going to get to a position where you're starting to hire salespeople back, engineers back? We obviously went through a reduction in force, and we went back to profitability, right? In 2022 into 23, the big theme was, how do we get back to profitability? Now the question is, okay, we got profits back, growth is slowed, how are we going to step back into growth? And it seems like IT budgets are opening. It seems like the environment's better. If we get rate cuts this year, it should theoretically be better for consumption of software this year. So, we're watching and listening for all those details, among many other things. But I think, again, I don't think 24 is going to be as good a year as 23 was. 23, everyone was positioned in semis. No one owned software. And then our index, the software and internet index, really picked up steam through the year and had a really strong finish. And so I think we started the year with a bit of a hangover. These stocks are all down between 3 and 10% across the industry. And I think it's down because we had such a giant move. Many's indexes are up 60, 70%. It makes sense, digesting some of the big gains and then waiting for the next entry point on a pullback.
It's true. I know a lot of people will be very attentive this earnings season. I see your dog joined the conversation too. Obviously very interesting for him as well. Appreciate you joining us, and Happy New Year, Brent Thill. Thank you so much.
Happy New Year.
Well, the NCAA and ESPN announcing they will continue their programming deal. That means for 40 NCAA championships will be appearing on ESPN networks over the next 8 years. Now, sports media is going through an evolution, with streaming services jumping on the sports coverage bandwagon and consumers shifting how they want to watch their favorite teams. Let's bring in Ed Dessa, president of Dessa Sports Media, to discuss more. Thank you for joining us this morning. So walk us through how we saw some of these sports rights deals get pushed up to this degree.
Sports has become the most important form of programming for linear networks, traditional television networks. And it's really the only thing that generates significant audiences on a reliable basis. So that has caused more interest among traditional networks. And then add to it the fact that streaming services are also starting to look for sports programming to augment their generally scripted programming. And so you've got an increase in demand against relatively fixed supply. And it's as simple as that. Now, it's worth mentioning that there has also been a decline in purchasing power by some of those traditional networks as cable cutters have impacted the top line revenues.
I mean, but I have to ask you about the size of the deal. I mean, it's roughly triple what the current deal is, looking at $115 million annually in this 8-year deal. Do you think, given the shape of how streaming has changed, and perhaps even some of the record-breaking performances we saw from these college athletes over the past year, is that also adding fuel to this?
Well, certainly we're seeing greater interest in women's sports, and that's really the major change. Audience levels for men's sports have been relatively fixed and even have been declining a little bit just based upon the overall marketplace decline. Women's sports have been doing quite a bit better in recent years, and last spring, the NCAA women's basketball tournament registered nearly 10 million viewers, which is an all-time record. That is providing additional fuel for the trend. But as I said before, the key here is that there is more and more interest in sports because it's live, because people watch the commercials, because it's topical, and for many other reasons. And so sports programming has been the big beneficiary of the increase and adoption of streaming. As more of the entertainment programming has gone to streaming, that has left sports, as the predominant property for the linear networks like ESPN.
And Ed, I mean, a lot of people's heads are spinning as to where they can find, their favorite content, as we're seeing a lot of these deals and these M&A deals as well. But it's traditional television, it's streaming. You have tech giants entering this space as well. What does this mean in terms of the pie for advertisers?
Well, obviously, having more places to look is an issue for subscribers and fans. And so discovery is a bigger challenge. And I expect that will be addressed over time as there is more viewership of sports events on the streaming services. As it relates to advertising, advertising has always been a very popular part of the revenue stream of sports telecasts. And it's a very reliable audience. The demographics are good. And for many products, ranging from insurance to quick service restaurants to beer, it's a place that sponsors have flocked to over the years. And so I think the fact that it's maybe more streaming than it used to be doesn't dampen the interest of sponsors at all. They will migrate to where they need to go in order to reach their clients.
I appreciate you joining us with that breakdown. Ed Dessa, president of Dessa Sports Media. Fascinating time to be in streaming and sports right now.
Happy to be here.
All right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
EU antitrust chief Margareta Vestager announcing she will now meet with chief execs from key tech giants next week, including leaders from Apple, Nvidia, Alphabet, and Broadcom. For more on this, we turn to Ryan Heath, Axios global tech correspondent. Thank you for joining us this morning, Ryan. So we know that the EU has really been taking the lead here on framing an AI framework here. What are the expectations for this trip?
Well, it's a double-hatted trip, actually. So yes, the EU has locked down its new AI Act, but the big thing there is it's actually not going to be in force for another year for the first half, and the second half, it's going to be 2 years before they start implementing it. But the way regulators work, obviously, is playing catch up to markets a lot of the time. So the previous big piece of legislation, which is about trying to limit the power of big tech gatekeepers, that's really coming into force from March this year. So Vestager is going to be here previewing the AI Act, but also a little bit reading the Riot Act about this digital markets legislation, which is really trying to make sure that the big companies run open ecosystems. They don't try and lock you into their app stores. They don't preference their own systems. So she's going to go around these companies one by one and work through how they're going to relate on this legislation together.
And Ryan, how do you think this is going to be received? Because if they're really being perceived as gatekeepers here, but they also want to be really at the forefront of some of the legislation as well, how do you balance that?
Yeah, it's really tricky. So the companies have a very different attitude to 10 or 20 years ago, and some of them are very new too. So they've only ever known this very aggressive European Union. But I think the Googles of the world, the Metas, the Apples, they've come to realize the EU isn't going away. They don't particularly like the way the EU approaches regulation, but they know that it's a very lucrative market and it makes more sense to play ball with them at some level. So there's this constant tension between how do they give a little bit to the EU, look cooperative, but at the same time, don't do anything to cannibalize their business. And that's the constant back and forth between the companies and people like Vestager. And she's back in the hot seat now because she was running for a new position to be head of the European Investment Bank, and she lost out. So now she's coming back with her tail a little bit between her legs, and she's got 1 year left to secure her legacy and make a difference. So you might see a slightly fine-tuned Vestager in these meetings as well.
So are we expecting her to really try and make her mark here, or really try and do what it takes to really get some results here, as you said, because the legislation isn't supposed to kick in for another year?
Yeah, I think she's really got to try and secure some results. She's a pragmatist at the end of the day. She sets sort of fairly radical and ambitious goals, and then she sort of puts her head down and tries to find pragmatic ways to get some of the way there. And now she's really into that tail end of her time in Brussels, and she's had a few defeats in big court cases over the past 12 and 18 months. So it's really time to show some results. It's not enough to just wave a piece of legislation around. She's got to actually make a difference in how these companies operate, in how the market itself is structured. And so I think there's going to be a lot of that pragmatism on show during this visit.
And Ryan, we know that there's been a lot of antitrust push here for some of these big mergers and acquisitions here, and really the pace of innovation not keeping pace with regulation in the US. Some saying perhaps the US might follow the EU's lead. But in terms of actual progress made on either side here, who's really leading the way?
Yeah, it's more like everyone is driving around a roundabout at the moment. It's not that nothing is happening, but the US system has been, under the Biden administration at least, really taking a leaf out of the EU's book on antitrust, but they haven't been able to update any of their laws. Like you see very aggressive regulators at the FTC, like Lena Khan. You see very active conference circuits where people do come up with new ideas. They do try and find ways to apply this EU approach to antitrust, but we're not seeing a lot of successful court cases. We haven't seen a big new piece of legislation come out of Washington. So there's a lot of activity, but not a lot of progress on the US side. And then, of course, US antitrust always has the courts involved, unlike the EU system, where the courts are much less involved. And then when you sort of like move to the parallel game of how is AI going to be regulated, because there is such gridlock in Washington, you're going to start to see the courts get really involved in issues like copyright in the course of 2024. You have big lawsuits from companies like the New York Times. You have other creators who are basically saying OpenAI and these other big AI companies have literally just stolen their content and are now making money out of it. And because you're not getting the legislation out of Washington, you're going to have to get some kind of resolution through the courts. So there is going to be action on a lot of fronts over the next few months.
Certainly may be a case of regulation by legislation, or the other way around there, as we're seeing really a lot of these state-by-state actions here, as we're really waiting for some sort of action out of Congress. Appreciate you breaking that down for us. Ryan Heath, Axios Global Tech correspondent, thank you so much.
Thank you.
Well, let's get you a final check of the markets as we head into the noon hour. Seeing a little bit of selling off action, although still green across the board so far this morning. The Dow, though, really paring back some of those gains, currently just up about 25 points, relatively flat. Same story with the S&P 500, also pulling back, now just to the green by about 0.4%. Tech-heavy NASDAQ as well, also up about 63 points on the day. That hotter than expected jobs report still being digested, although a lot of people wondering now if that March rate cut from the Fed was a little bit presumptive by investors here. So really a bit of a cautious tone here and quite a bit of volatility so far this morning. Well, that does it for now. I'm Rochelle Akufo. I'll be back with you on Monday. Have a great weekend.